certainly don't expect this rally to continue to have the same type of legs that we've seen.
The systemic risk is that we've priced in the Goldilocks scenario.
The question is the Fed actually going to be able to engineer another 125, 150 basis points of rate hikes from here?
They're going to persist with the rate hikes. They're going to persist at a slower pace, though.
The market feels it knows what the path of the Fed is going to be.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro, together with the brilliant Katie Lyons. Bramo back with us on Monday. Futures right now up 0.1% on the S&P. TK, it's a clear shot right now onto Jackson Hole, Wyoming.
On to Jackson Hole, which I believe is still in August. And what it says to me when I look at the screen this morning, John, it's August. That's where we are right now. It's got that real August feel. And, you know, after the economic data, the jobs report, CPI, the interesting retail sales report, you're right. All that matters now is the chairman's speech in Wyoming.
When you say it's August, do you mean it's snoozy? Are you saying it's quiet, Tom?
Well, don't tell that to 1998. But the answer is I look at the screen, John, and I frankly see a pretty accommodative screen, but we're just looking for the next news information to drive things forward. It's out there somewhere.
Allow me to wake you up, Tom. Forecasts on China GDP out of Goldman and Nomura. Goldman Sachs at 3% for 2022. Nomura go down to a two-handle, 2.8%, Tom, a two-handle for Chinese growth this year.
And Nomura's got some real authority there with their years and years of Pacific Rim coverage. John, those are really important numbers because they redound all across all of the Pacific Rim, and that's how you get the global GDP of 3%. And let's look back again at World Trade Organization. We all laughed at 2.8%. Right now, they look smart.
They are global recession-type numbers, Katie Lyons. They are not pretty numbers at all.
And we know that China is going to do something to try and support that. We've already seen the surprise rate cut. We now have talk of more fiscal policy with potentially $229 billion in bond sales coming from local government. Even Xi Jinping out on CCTV earlier saying they will persist with opening up the economy. They're dealing with a serious downturn in the property sector, COVID zero policy weighing on the economy. The question is, can you have enough stimulation on the monetary and fiscal side in order to offset that?
Kayleigh, you can end the debate on the Federal Reserve. Dovish or hawkish minutes, what were they?
I think whatever your bias was going into that meeting, you got it confirmed. Because if you were in the dovish pivot camp, the idea that they are saying they are going to slow rate hikes eventually confirmed that for you. If you were saying, no, they're still hawkish, then you would cling to the language in there about being persistent in the fight against inflation. So I think you can read it both ways, and that leaves us with a very sleepy morning the day after.
You read them. I read them. You know who didn't read them?
Thank you.
Tom Keene. Tom Keene slept through that.
Several. Can I talk about some good research, John? This is a real commitment of grinding it out every day. There's a lot of people that do that. We protect their copyright. Julian Emanuel with Ed Hyman over at Evercore ISI with 95% of earnings. And John, I'm shocked. It was a surprise to the upside, and he rounds it out at sales up and inflation like 13.9% nominal. Earnings up 6.4%. The world's not going to die as we know it.
Bramo's not here, so I've got to do a Bramo. How much of that's energy?
Yeah. Oh, that's part of it. It's part of the mix, no question about it. But I just, we're framing up. Have we discarded the OMG recession talk? Are we like past that?
I don't think we are, Tom. Maybe we pushed that out just a little bit, delayed, but ultimately not unavoidable. Seems to be the view. Right now, the consensus.
I think Jim Bullard. I think Mike McKee's scheduled to talk to Jim Bullard with us in Jackson Hole, and Mr. Bullard of St. Louis is going to say, nope, there's no recession.
We've got a great lineup next week. I'll share that with you a little bit later.
Nice
Maybe next week, Tom. We'll do that early next week. We'll go through our lineup. For our audience. Futures right now, positive 0.1% on the S&P 500, always sensitive, TK. The Nasdaq up 0.2%. Yields coming in a couple of basis points, 288, and crude positive by 1.4%, but still trading in the 80s. Kayleigh, 89.36.
Yeah, indeed. And of course, the fact that oil is so much lower than it was speaks to that demand story and a lot of concern out of the China story in particular that we were just talking about. It's going to be a focus on the U.S. economy, though, later today. We're going to get a series of economic data points, though arguably less important than the likes of retail sales and CPI. At 8:30 a.m. Eastern, we're going to get weekly jobless claims. We're expecting a 264,000 print on the initial claims. But of course, this would just be 1 week in a series of weeks, really going back to April, in which we have seen a steady climb in the claims
claims number. Yes, they're still historically low. They're still south of 300,000, but it still speaks to a cooling in the labor market that arguably is what the Federal Reserve is trying to engineer. Then at 10 a.m. Eastern time, we'll get existing home sales. They already have engineered in a real way a slowdown in the housing sector, with mortgage rates now about 250 basis points above where they were a year ago. We have seen it showing up in the data. We're expecting a 4.9% decline in existing home sales month on month. And of course, that follows the new home sales figures we got earlier this week, also speaking to a slowdown in home builder sentiment that has fallen for, I believe, 8 months in a row, the longest streak of that since 2007. Finally, we'll round out the day with some Fed speak. Both Esther George of the Kansas City Fed and Minneapolis Fed President Neel Kashkari will be speaking in the 1 p.m. hour. I'm more interested in Kashkari because remember when he was a dove? He is now firmly a hawk. He sees the Fed at 4.4% next year in 2023. So how much does he double down on that today and try and clarify a Fed minutes that could be read in multiple ways, John?
Given where rates are right now and given where inflation is, some people might say the whole lot of them are still dovish, Tom, based on that. And Katie, thank you for that. You're day ahead. TK, are they still a bunch of doves pretending to be hawks?
No, I think that we've switched to are they hawk or hawkish or more hawkish in that kind of idea. And again, John, that's with an optimism on the American economy and the way forward. If you believe in a recession, you got to go the other way.
Joining us now, Callum Pickering, senior economist at Berenberg. Callum, we've had quite a rally since this Fed chair last spoke. Do you think he gives this rally his blessing?
Hard to say. If I were the Fed, I'd be inclined to stay hawkish, even if markets start to anticipate that the worst of inflation is behind us. The last thing the Fed would want to do is over-eagerly slow this pace of tightening and then restart these inflation pressures. We've got major supply uncertainties to come over the next few months. And the U.S. actually, in nominal terms, so exclude the inflation for a moment, just look at the U.S. economy in cash terms, it's still growing very fast, far too fast relative to what you would want it to be growing at in order to hit that 2% target on a sustained basis.
Caleb, we have spent a lot of time on the glide path of inflation to disinflation, and maybe there's kinks and stopping points along the way. The United Kingdom seems to be a different calculus, to say the least. Do they need an emergency rate hike now to get it out of the way so the government and the new government can move forward?
It's a good question. I don't think there's anything you can actually do from a monetary policy perspective to affect where inflation is going to peak. That's really a supply story. But the UK is an interesting case. It's got mid-Atlantic characteristics. It has some of the demand side pressures that the US has. It also has some of the supply side problems that continental Europe has. And so there's a greater role for the Bank of England to shape inflation than, say, the ECB. It's a bit more like a Fed situation. The thing I'm focusing on, not just in the UK, but in continental Europe and the US, is the margin squeeze to come. I don't think markets are going to enjoy what happens in the second half of the year because they're going to see, if this monetary medicine works, that firms are unable to pass these high input costs onto consumer prices. That's the reason firms, by and large, actually think the market is overreacting to this recession risk. But central banks are going to have to cause this pain. So that margin squeeze is the thing to come.
Well, on the subject of causing pain, Danny Blanchflower was speaking on Bloomberg Radio. He, of course, a former BOE policymaker, saying that the BOE shouldn't be hiking rates. They should be cutting because of the recession that they're about to cause. And it brings me back to the Fed minutes as well and the risk of overdoing it. From your point of view, Callum, is there a greater risk of underdoing it or overdoing it?
Well, judging by the experience of the last 18 months, the risk is that central banks underdo it. And I am really focusing on the difference here between the economy in nominal terms, that is cash terms, and then the economy in real terms, so it's output. And what we have is economies in cash terms growing far too fast, but at the same time being squeezed by these supply problems. So in output terms, things are getting worse. Output is what defines the recession. And so when analysts and other economists say that the economy is slowing, I really ask them what they're focusing on. Because if we think about this in nominal terms, which is what central banks care about, then actually the problem is overheating, not the slowdown.
Callum, I need you to translate some central bank speak. The chairman talked about the neutral rate a lot in the news conference. He was criticised for it by the likes of Larry Summers, who said, how on earth are we neutral? I'm paraphrasing there, but you get the point. In the minutes, it comes up twice. They refer to two concepts, the shorter run neutral rate and the longer run neutral rate. Callum, for people not familiar with those concepts, what do they mean by that, and what's the story there?
Theoretically, they exist, but for policymaking in the near term, they're not very helpful. The short run rate is essentially what balances output and inflation over a 1 or 2 year view. The long run rate is what would balance the economy in equilibrium. But when central bankers use this kind of language, they give the impression that they can fine-tune economies, and they simply can't. There's too much uncertainty and there are too many complications at the moment. The only thing that central banks can do is take a gradualist approach and focus on inflation expectations. So basically, keep raising interest rates without fully tanking the economy in a way that keeps inflation expectations anchored, and then hope that once these supply shocks have passed, once demand starts to normalize, you arrive at something like 2% inflation. Central banks are powerful institutions, but they're clumsy institutions. So let's not, faced with uncertainty, give the impression that they can, with kind of a scalpel, fix interest rates and inflation on a 12 or 18-month view. They simply can't.
Callum, awesome to catch up. Callum Pickering of Berenberg. And TK, just to pick up on the language that Callum used just there, clumsy institutions, using some very precise language.
Yeah, I'll go with that, but they're coming out of a pandemic. I'm still going to cut them some slack. I would really emphasize, John, and this goes to Jackson Hole, they're making it up as they go. And I just can't say that enough with the data dependency. I haven't even looked to see what the new economic data is, other than John claims here this morning. What if we get a jump in claims? Does that bring in this labor labor debate
Bit of a trend there. The last month or so, Tom. So something to watch for at 8:30 Eastern time.
Yeah, there's no question. I mean, the claims is there, and Mike McKee's looking at continuing claims, which is a broader statistic. But within the mix, I'm going to go back to Julian Emanuel. I'm sorry, corporations delivered.
I'm going to go to Sema, Shah, Tom, of Principal Global Investors. She's going to join us in the next hour. Looking forward to that. And we'll catch up with Alex Webb, who we haven't caught up with for a while, Tom.
Well, he won't talk to me
United.
anymore.
He wants to talk football.
Oh,
so he's going to join us in about 30 minutes' time. Yields down about a basis point, a 10-year 288. Futures positive 0.2% on the S&P from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The US and Taiwan are following through on a long-time promise to deepen their ties despite opposition from China. The two countries will start formal talks on a trade and economic initiative this fall. Still, a trade agreement may be more symbolic than substantive. Both Republicans and Democrats have been reluctant to embrace free trade agreements. Officials at the Federal Reserve agreed last month to eventually dial back the pace of interest rate hikes. At the same time, they wanted to measure how their monetary tightening was curbing inflation. That's according to minutes of Fed policymakers at their meeting in July. Officials also saw a significant risk of entrenched inflation. In the UK, the so-called summer of discontent is about to get worse. Britain's faced some of the most widespread disruption yet due to strikes by rail workers and bus and subway staff. That will be followed Sunday by an 8-day strike by dock workers at Felixstowe, the biggest container port in the UK. And in China, the number of COVID cases has surged to a 3-month high. It's being driven by an outbreak in Hainan province. That's the biggest since the spring. There were more than 3,400 new infections reported on Wednesday. More than 2,000 medical workers have been brought into Hainan to help. And exports of Swiss watches rose more than 8% last month, the highest level since 2014. Demand for luxury timepieces from the likes of Omega soared during the pandemic. Exports to the US rose 13.5%. It's the biggest market for Swiss watches after overtaking China last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Although we still have about 4 million people out of the pre-pandemic workforce, we continue to see strong employment gains and low unemployment rates, the kind of labor market that has historically pulled in more workers.
There's Michelle Bowman there, the Federal Reserve Governor. You're going to hear a ton of Fed speak next week. We'll be on top of that for you with Tom Keene. I'm Jonathan Ferro, together this morning with Katie Lyons. Bramo back next week. She'll
So
catch
she
up with us
says.
on Monday, Tom, and then we'll head over to Wyoming. Futures right now up a little more than 0.1% on the S&P. Yields are just a little bit lower, down a basis point on a 10-year to 288.22. Katie, just quickly, some news out of Germany that's notable.
Yeah, Chancellor Scholz is speaking to reporters in Berlin, talking about rising energy prices and the great burden they place on many citizens. And as a result, Germany will be temporarily cutting that value-added tax on gas to 7%. They say that reduction will last until the end of March 2024. But clearly, governments in Europe, John, doing what they can to kind of lessen the burden on consumers there as energy prices are just astronomical.
The thing that jumps out to me there, Kaylee, and Tom, it's March 2024.
Yeah.
Tom, March 2024.
Yeah.
We're not talking about next spring. We're talking about preparing for pain to go into 2024.
Let's look at the calendar, John. I mean, I know you're riveted on how the leaves change color coming down from Canada into northern New England. Ferro folks
That's an American thing. I'm not into that.
Third weekend of September.
I
John
mourn the
Ferro,
end of summer.
Woodstock,
you
Vermont.
celebrate it. I don't know what that's about.
We could
Tom.
road trip Woodstock, Vermont. You know that.
Would you like to do that?
would be
Okay.
good,
Road
John.
trip.
We could, leaf peeping and all that. But John, the weather's coming on. And I don't know. To me, that's a Band-Aid announcement by Scholz.
Sure.
John, you tell me 30 days, 60 days, definitely in 90 days. This is the debate.
I'm seeing bank after bank, Tom, say winter is coming. Winter is coming with a recession for the European economy.
Yeah, well, we'll have to see on it. Futures up 6, Dow futures up 38. Emery Horton with a brief on Washington. Emery, a general statement, and I understand it's a sleepy Washington right now. Exactly how overwhelmed is President Trump with the sum of news flows of legal matters, even if he's not involved? Witness Mayor Giuliani down in Georgia. I mean, what's the level of overwhelm that President Trump faces?
President Trump and also the Trump Organization, because we also know that his CFO is going to be pleading guilty in this long investigation to the Trump Organization. Basically, they didn't pay income tax. The CFO was potentially paid in things like a Manhattan apartment and vehicles. So he has, on a number of fronts, a number of investigations. And today will be very telling because we're going to have this hearing. A number of media organizations, Trump organization, or his presidential campaign, they haven't actually asked for this request of the affidavit to be released, but a number of media organizations and conservative groups have. And we're going to have a hearing from this judge because this is setting up a bit of a fight, right? Because the DOJ has been pretty clear they do not want this affidavit to come out because they think this would hurt the investigation.
He's raising money, I guess, off of this. I noticed Vice President Pence pushing back, like, stop yelling at the FBI kind of language as well. But where do you perceive President Trump will be in 30 days, or do we just don't know?
I'm not sure we know just yet. I think you'll see a lot of the same, which is, as you mentioned, he had a number of fundraising wins 2 days following that raid. I think it really depends what comes out. We have to wait. Let's see if we get this affidavit. I think one thing was incredibly interesting yesterday at a speaking engagement. The former Vice President Mike Pence had said that he would consider an invitation, if it was given to him, to show up at the January 6th Select Committee. So I potentially think, when Congress is back in session, that committee really just has a few months, especially given the fact that Representative Liz Cheney is such a powerhouse in terms of her stance on that committee. We have to see where the summer and fall go. But certainly Trump is going to spin this and use this, not just for campaign dollars, but potentially to fuel a 2024 run.
Yeah, it raises the question of whether it's going to be more politically explosive if the affidavit is released or if it is not. Anne Marie, where does the Biden administration come down on this? Would the president like to see it released?
Silence. The administration has been absolutely silent, and they say they do not want to get involved. It is not their job to get involved. They are not briefed on this, and they are leaving it up to what they say is, of course, the independent bodies of the FBI, which we should note. The head of the FBI was appointed by the former President Trump, and the Justice Department. The Biden administration does not want to touch this.
MH, we've got a special story to talk about of yours in Bloomberg Business Week this week. We're going to do that in the next hour. Looking forward to catching up. MH, down in D.C. Got to go because TK wants to talk about fall and the seasonal changes. Kaylee, welcome to Bloomberg Surveillance from 6 to 9 a.m. Eastern Time. TK, go on. Central Park, brown leaves. You want to do this already in the middle of August?
John, I think we need to do a remote. The November 2nd Fed show, we've got to do in Central Park. 18,000 trees. We need to get lucky here, John.
It's just to cut down your commute.
The peak is, end of October. But, John, 18,000 trees on a fiery glow. We can have Mayor Adams in to talk about Fed policy, its effect on this great city. But, John, the Fed show, November 2nd, remote from Central Park with all of that history, and John, the blazing glory of an autumnal Central Park.
Okay, I'll come if Chairman Powell turns up, I'll be there. I'll give you this. I
Maybe
used to
we'll
have the
get Bill
same
Dudley.
view that you have because I used to live in the same building before you moved in and then I moved out. And that view, Tom, is pretty special across Central Park.
Well, you know, you have to walk up, but other than that, it's great. I mean, you just barely see over the trees.
Floor. Sure, okay. Can I hit the price action?
John, I just think November 2nd, it's an autumnal Fed meeting.
You're calling it autumnal and not
autumnal.
Fall. I noticed that. Thank you. I appreciate that.
Because I read,
that
Coleridge or somebody.
All right, okay. Futures are up, Tom, 1/10% on the S&P. On the Nasdaq 100, up around about 1/10% as well. Yields coming in a couple of basis points, 286.86, 287.86. In the FX market, euro dollar 101.69. Schnabel of the executive board this morning, Tom, talking up another 50 basis point hike potentially.
Oh, they got to go.
September 8th.
What are they waiting for? I'm seriously, I'm baffled by this, John.
Well, Katie went through the data this morning, Katie. What did we get? 8.9%
Yep.
CPI.
Yeah, hot in Europe, and the ECB needs to fight it. I just wonder how effective policy changes are going to be, even if it is a 50 basis point hike, when your problem is energy, and that isn't a problem that is going to be solved by tighter policy. That is in large part dependent on Russia.
A supply side story on the energy side, Tom, and it's hugely problematic for the Europeans.
It is.
Hugely problematic. I think some of the good news we've seen out of Germany is that the storage levels are climbing in a way that's ahead of expectations, but still, even if they get them to where they want to be, where they want them to be, at the time they want them to be, still going to be a difficult winter, Tom, for the Germans and the Europeans.
Yeah, you know, we're making jokes about autumnal, folks, but this is really, really serious. And frankly, it comes over to the United States as well at a much lesser level. What we can do, John, road trip. Think of when it'll be autumnal in Charlottesville, Virginia. I mean, I'm talking like late November, John.
Magic.
We could do Central Park. We could do Central Park, and then Kaylee could join you, me, and Bramo. Charlottesville.
Okay.
Autumnal.
I'll bring snacks.
Sold. Is it warmer there?
Yes.
Yes,
it's wonderful.
It's south,
okay,
John.
Good.
It's south.
Tom is calling this a snoozy August morning, so good morning. I'll keep it brief for you. Try and keep you awake as well. Futures positive 1/10% on the S&P 500. Losses yesterday, snapping a three-day winning streak on the Nasdaq. Deep losses. We bounced back a bit, up a little more than 1/10%. Turnaround in the bond market too after Fed minutes yesterday. Take a look at 2s, 10s and 30s and just take a look at the 2-year. We were 10 basis points north of where we are right now at 337. Incidentally, that's only about 8 basis points off the intraday high in the 2-year for the year so far. Got to go back a number of years to get to those kind of levels. Right now, 327. Yields really backed away after the Fed minutes, Tom. Dovish, hawkish. I'll tell you what the market did. Yields faded at the front end of the curve after those Fed minutes. Right now, unchanged at 327.89 on a 10-year, 288.
For the pros, John, I'd summarize with the Bloomberg Financial Conditions Index. I believe it's 11 statistics, maybe 11 ratios, invented by Michael Rosenberg. It's very, very valuable, and it still shows huge accommodation here, moving away from the restrictive things that the Fed desires.
In Europe, they're looking to take back some of that accommodation, so let's finish
What are they waiting
on
for?
Europe. Euro dollar, the German economy, the German bond market. Euro dollar looks like this, 101.67, negative 1/10%. Yields creeping a little bit higher at the front end of the German curve to 0.757%.
Yeah.
Schnabel of the executive board over at the ECB in an interview with Reuters, teeing up another 50 basis point move on September 8th. The concerns they have, she says, have not been alleviated in the last couple of months, Tom. And for that matter, just look at inflation this morning, 8.9% in Europe. TK, how long have you and I been talking about Europe? Did you ever think we'd sit here and talk about inflation close to 9% in the Eurozone?
And very quickly before we get to David Wu, John, this is so important in that Europe is raising into a lesser believed nominal GDP, and Europe is raising into an economy that doesn't have the technology gift that America has.
They're hiking into economic weakness and they're hiking into potentially, Tom, an energy crisis later this year.
Now, maybe Madame Lagarde's listening this morning. Christine Lagarde, we'd love to see you in Jackson Hole. I think that can be arranged, as Mr. Draghi used to attend. Don't you think, John?
I couldn't agree more.
Christine Lagarde.
Is that you asking for an interview, Tom?
Yes, for that matter, David Wu should attend as well. He's a chief executive officer of David Wu Unbound, but far more holistic work for Merrill Lynch and Bank of America over the years. David Wu, thrilled to have you on this morning. I want you to partition a conventional Hicksian model in that you've got the IS, the real economy, and the LM curve, the financial economy. Which matters right now to our viewers and listeners?
I think it depends where. I mean, Tom, thanks for having me on again. I think in Europe, definitely the IS curve is shifting to the left because what you're seeing right now is basically a negative productivity shock, right? Basically, as a result of the war in Ukraine, that's basically sent, for example, natural gas price in Europe actually to an all-time high this morning, by the way. So clearly, that's a negative supply shock. That would have been that's a problem because it's a problem because it clearly, as negative supply shock is associated with basically high inflation. In the U.S., I think clearly there's been some easing of inflation because food prices and oil prices having basically started to moderate. But I think there's no doubt in the case of the U.S., I think there's no doubt that basically policy remains too accommodative. I think especially in monetary policy, as you said before, financial conditions have eased actually 4 weeks in a row. And I think this is why Europe and the U.S. are in a very different place right now.
David Wu, if we have a debate at Jackson Hole about a path to 3% inflation or 2% inflation, do those two differences affect America's productivity? If it's productivity, Adam Posen's 3% inflation, or what the Fed wants and Powell wants, a 2% run rate?
I think at the end of the day, Tom, honestly, what really has taken me by surprise is just how complacent the market is right now about, basically the outlook for inflation under the various basically scenarios for monetary policy. If you actually look at what the market is pricing in terms of the inflation outlook right now, 1 year break even is trading somewhere around already 2.5%. In other words, the market thinks basically in a year's time, inflation is going to be back at 2.5%. This is notwithstanding the fact the market thinks that the Fed funds rate is only going to basically go to 3.25%. It's going to start to come down already by next year. So from that point of view, if you look at the history of the United States, going back the last 70 years, we've never had the end of a Fed hiking cycle without real rates having gone to at least zero, if not positive. Right now, the market is saying that we don't need to go to positive real interest rates, and the Fed is going to be able to bring inflation back down to 2.5%. And call me a skeptic, but I find that just completely crazy. And I think I have to say, Powell has been unhelpful in the sense that he's been encouraging people to think that the neutral Fed funds rate is still 2.5%. And that is absolutely, essentially crazy talk.
Yeah, so we'll see how much he has to talk that back in Jackson Hole next week, David. When you talk about how getting inflation back down to target is unrealistic and crazy, where do you think it ultimately is going to settle, and where is Fed funds when that happens?
Listen, I mean, I think that's a very good question. I think obviously, it depends if you ask me as an economist or you ask me as a political analyst. I think a lot is going to happen after the U.S. midterm elections. I think, especially after the raid on Mar-a-Lago, with 93% of Trump-backed candidates having won their primaries, I think the showdown around the midterm is going to be huge. So I think from that point of view, I mean, I've always said, the last 20 years, most of my career as an economist, I would say economics is driving politics. I suspect we're now in an environment in which politics is driving economics. So I think it basically makes it unpredictable. But I have to say, though, I think more likely than not, inflation is not going to go back down to 2%, or even for that matter, 2.5%. I think more likely we're going to be at 3%, or maybe even a bit higher. And I think from that point of view, the likes of gold and so on and so forth are going to do fairly well when the market reaches that realization. But right now, I just don't see how the Fed is going to be able to actually bring inflation back down to 2% without taking rates to at least 4% or higher.
And to bring inflation down, is a recession necessary?
I personally think, we can sit here and talk about recession. I actually think that the U.S. economy can cope with high interest rates much better than most people assume it will. If you look at basically, household leverage, it's at the lowest level in 20 years. If you look at corporate leverage, it's at basically all-time basically low. If you look at bank leverage, it is at all-time low. So from that point of view, normally when interest rates go up because of the leverage in the system, that causes consumers to pull back, companies to pull back, and banks to pull back. This time, it's not happening because incredibly over the last 20 years, all this leverage in the private sector has basically moved on to the public sector, the government balance sheet. And the government is not going to stop spending because interest rates are high, as you just basically saw with Congress passing the latest basic climate bill. So my point here is I actually think the U.S. economy can withstand much higher interest rates than I think people give it credit for. And this is the reason why I think rates ultimately will have to go much higher.
David Wu, let's go back to your art skills of time ago, and let's talk about China and the renminbi. Is there an optimal renminbi for China, or is their economics such a fiction it doesn't matter?
Tom, I think for China, I think the Chinese right now are literally like, they're getting very nervous. I think they're getting very nervous. It's not so much about the real estate market. It's not even so much about COVID. It's about this Cold War with the U.S., which is, they think it's about to blow up in the open. Now, I'll tell you, I've developed basically a Cold War II survey in conjunction with Rewe, which is one of the leading online technology survey firm in the world based in Toronto. And what I'm finding is that it's pretty amazing. Only 3 months ago, 20% of Chinese view America as basically an adversary or an enemy. As of today, that number has jumped to almost 40%. I mean, largely as a result of Pelosi's visit to Taiwan. But there is no doubt that increasingly so, that Russia and China see that they are in the same boat, And I think from that point of view, I think the Chinese, the way they're thinking about their renminbi policy right now is how are they going to be able to actually compete with the U.S. in this world in which that they see Washington coming to get them. And I think this is going to be the big question. And I think from that point of view, I personally think they also realize they don't have that much time left. They cannot let the whole real estate market to play out, the COVID to play out. I think they're going to be stepping on it. And I think especially given the latest batch of poor data out of China, I think you're going to see more stimulus because they feel like they might have to get ready for perhaps a more direct confrontation with the U.S. at the start of next year. You saw the U.S. and Taiwan are about to basically begin to free trade negotiation. I think that is the kind of thing that the Chinese are afraid is going to get out of hand, especially Congress, as you know, are now trying to basically push through this Taiwan Policy Act, which will represent a total overhaul of U.S.-China relations. And I think the Chinese feel like right now, they got to get their economic act together very soon because they might have to basically really step up to come from the U.S. at the start of next year.
So, David, you're talking about getting their economic act together in the relative near term. But as you talk about those geopolitical factors and the worsening of relations between the U.S. and China, potentially just a further decoupling of the world's two largest economies, what is the long-term economic ramification of that?
It's everything that's bad. Honestly, I think what people don't realize is so many people who are too young to even remember, so much of the good times, at least on Wall Street the last 20 years, is because of, the whole integration of China in the world economy, which drove down inflation, drove down interest rates, and drove up the stock market. So from that point of view, there's no doubt. There is no doubt. The decoupling between U.S. and China means that we have to build basically two of everything. We need two payment system, two basically, trading system, two technology system, and two is going to be more expensive than one. So from that point of view, there is no doubt this is going to be a major source of inflation. I have no illusion if the U.S. is going to now the U.S. the taxpayers is ponying up $60 billion to basically make some semiconductors in the U.S. That means, semiconductors is going to get more expensive. So I think all in all, this is really, really bad news, in my opinion. It's too bad.
David, we've got to leave it there. It's got to catch up. David Wu there, the CEO of David Wu.
Thank you.
Unbound. TK, he's not the only one looking at those themes. In fact, some people want to put some money behind that kind of theme.
Well, that's what David Wu was so wonderful at with David Goldman at Bank of America ages ago. And, the thematic thing, John, now is not to be taken lightly. We're making jokes about it. We're making jokes about the leaves. John, this is a really serious time. There's a lot of people out there getting crushed. And the answer is we got to find a theory to hang on. It's out there somewhere. I'm just not sure which one it is.
Coming up, a lighter story, Tom. We'll talk about sport, Manchester United, and Alex Webb out of London is going to join us on that story. Futures up a couple of tenths of 1%.
Never talks about the tots.
On the S&P. Maybe he will next, Tom. From New York City, heard on radio, seen on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China is lashing out at a $52 billion program to expand American manufacturing of semiconductors. An industry association says it contains elements that violate fair market principles and targets China's own efforts to build a chip-making industry. The legislation prohibits companies that receive funding from expanding production of advanced chips in China. Meanwhile, China plans more fiscal stimulus as the economy's outlook gets worse. State media said the local government could sell more than $229 billion of bonds due to fund infrastructure, investment and plug budget gaps. Both Goldman Sachs and Nomura have cut their forecasts for GDP growth in China. And in the UK, a study warns that the next Prime Minister faces a worsening fiscal outlook that's raising questions about the viability of big tax cuts promised by the two candidates for the job, Liz Truss and Rishi Sunak. The Institute for Fiscal Studies says government borrowing next year is set to be $28 billion higher than forecast due to the impact of inflation. And more legal problems for former President Trump. The longtime CFO of the Trump Organization, Alan Weisselberg, is expected to plead guilty today to tax fraud. Bloomberg's learned that he will not implicate the former president, but he will be required to testify against the Trump company. And experts say his admission of criminal conduct could mean trouble for the business. Scientists are highlighting the mounting burden of chronic illness left in the wake of COVID. Researchers at the University of Oxford found that survivors remain at higher risk of psychotic disorders, dementia and similar conditions for at least 2 years. The findings are based on the records of more than 1.2 million patients. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
They're going to persist with the rate hikes. They're going to persist at a slower pace, though, and that's what the market has gotten wind of, and I think that's the main reason that we've seen this big equity market move off of the lows in the stabilization in the long end of the curve.
Let me give you a flavour of Tom Keene in the commercial breaks. Have you ever seen a moose in the wild? Real question.
I'm researching our 2-day trip to Leafs, and we'll get to that. And I don't want to waste time now, but I'm like looking at leaves and all that. So I'm looking at moose photos up in New Hampshire. It's too early in the season. I'm looking at Algonquin Park up north of Toronto, John, but they're already having the leaf season now.
I love how focused you are, Tom.
Thank you. I'm on it.
Futures up a tenth on the S&P, gone nowhere on the Nasdaq 100. This tweet came in about 10 minutes ago. How about putting some of that 3 times leverage cash back into Manchester United, Tom? Go full Britain Ted Lasso hybrid, manager investor. So Tom Keene tank stand would flow off a Max tongue with ease. A Mank is someone from Manchester.
John,
Tom.
this gets to a point, which is all these things we're talking about in English football, they've made a ton of money. The Glazer family's made a lot, right?
Well, they haven't made a lot yet. And our next guest is going to talk about that, Tom. There's some confusion around that, and I think it needs to be addressed.
Okay. Why don't you bring him in, John?
It's got your name in the prompter.
I don't
care.
You
want me to do it?
You know way more than I do.
Nuts. Alex Webb of Bloomberg joins us right now. Alex, great to have you with us. Let's tidy this up. The Glazers with a leveraged buyout back in 2005. And what I heard you do this morning, Alex, I think is so important because many other people don't understand this, including the Man United fans. It's about the interest payments on the debt. That's the important piece of this.
Yeah, absolutely. I piled through 17 years worth of financial statements, and they probably staked about $500 million in 2005 exchange rates to get the club. That was about a third of the equity at the time, it was 200 million quid or so, 250 million quid. But they've only actually taken out, in terms of lining their own pockets, about 400 million quid. Now, I say only, that's clearly not an insubstantial amount of money. It comes out at about $24 million per year. Now, $24 million a year, a lot of money by anyone's measure. It's also less than a lot of their top players earn per year. The real money is what they've been using to pay off that debt, both in terms of repayments and in terms of paying the interest. And that comes out at about $1.1 billion over the course of 17 years. And the crucial point is that that is what is supporting the value of their equity stake. Their equity stake is worth about $1.5 billion. in terms of the publicly traded piece, if they sell it in the private markets, as has been reported by our colleagues, that they're willing to sell a minority stake, it could be worth a lot more, and that's when they start crystallizing some of that value.
So, Alex, let's talk about the prospect of that happening. We reported yesterday that they are looking at selling a minority stake. Does anyone want a minority stake with the Glazers? Isn't that just a cash machine for them and perhaps not for the person buying it?
It would certainly seem that way. There is always hope, particularly amongst some private equity investors in the US, that the value of broadcast rights will gradually improve the profitability of the clubs. But as one former Premier League owner said, that famously, that no matter how much money they make in broadcast rights, because there's no salary cap, they will just spend it on player salaries. And so it's been reported by the Daily Mail, of all people, that there are talks with Apollo about possibly selling a stake. Jim Ratcliffe, Britain's richest man, told the Times newspaper, the Times of London, that he would be interested in acquiring a minority stake, but with the important proviso that he would only do so if there was a path to becoming a majority, to have a majority stake. And we're not sure there's much prospect of the Glazers being willing to do that.
I mean, John, keep this going with your knowledge of this. Is really what I wonder, John, is what does this do to Bernardo Silva? I mean, if they have this upset with the Glazers, what does Bernardo Silva do?
That's a Manchester City player, Tom. Don't confuse the clubs. But I'll play off that.
Oh, there's two
Alex
clubs.
Webb, the problem that they have is that they can't attract the talent like Bernardo Silva from Manchester City. They can't even attract the talent from Barcelona, who are in a much worse financial place. Walk me through what that actually means for building out the management of the team, recruiting players, when this is going on in the background.
I actually wrote a column a little while ago in which I said that Manchester United is like the General Electric of soccer, in the sense they are awful at capital allocation. They have spent money on the wrong players. They have not spent money efficiently on young players who come through and then are able to generate a lot of value. That is not the case with a lot of other clubs. A figure that a lot of people look at is the wage ratio. How much of the revenue is spent on salaries? Manchester United spends a disproportionate amount. One of your teams, Tom, is Tottenham Hotspur. They spend a very small proportion of their revenue, about 50%, on player salaries, similar with Liverpool, who have been very successful. So it isn't actually a terribly well-run club right now. They've got a new chief executive. It's not clear that he's managed to change that either.
To the two of you, and John, let me go to you. What in this process did they all learn from the Chelsea uproar?
That you can get more money for a club than we thought. I mean, I'll say up front, Tom, when I thought they were selling that, I thought they'd get much less money. Alex Webb, I thought it was a bit of a fire sale. I didn't think they'd get anywhere near what they got. So, Alex, I wonder what that means for the price of this club eventually down the road. If someone comes in with a big offer and just says, we'll take the whole thing.
I think, that is certainly, if somebody comes, everybody has their price fundamentally. But is there going to be somebody who's willing to pay in the order of £5-6 billion, which reportedly is the valuation that the Glazers are seeking? Chelsea was valued at about £2.75 billion. I would not be surprised at all if the timing of these talks have a huge correlation to the Chelsea deal, because they look at Chelsea, they think that it's a smaller club, whether that's true or not. Some fans might dispute it, and say, well, if Chelsea's valued at that, we should be valued at more. This is an opportunity, as I said earlier, to crystallise some of that value and line our pockets.
Do you want to call them a smaller club, Alex? You're welcome to.
I mean, for me, the biggest club is clearly Aston Villa, right? But
of course,
not sure anyone would agree with that assessment.
Without a doubt. Without a doubt. I think Prince William might agree with you. And Mervyn King as well, for that matter, too.
And David Cameron.
There you go. And David Cameron, though I'm not sure if he thought he was a West Ham fan or a Villa fan. I think he got confused.
Well, weirdly,
at
the
times.
fact that he's a Villa fan is because his uncle used to own the club, which is his own story.
There you go. I think he's cut from a very different cloth to you and I. Alex, thank you. Alex Webb,
Kaylee,
out of
that
London.
was brilliant.
Alex Webb's fantastic.
That was just
and he's right, Tom. The leverage buyout has saddled this company, this club, with a lot of debt.
John, important question and unfair. In North America, always the Toronto Maple Leafs are considered the most valuable franchise. There's the Cowboys in that. How do these British giants compare financially or in terms of balance sheet or asset value to the Cowboys, to the Maple Leafs?
As a franchise, Manchester United's right up there. Tom, Manchester United is right up there with the Dallas Cowboys. I think Deloitte put out a list, don't they, annually? But Manchester United's right up there. And you'd expect Manchester United, based on its global fan base, to be worth more than Chelsea, Tom, even if the team's not as good at the moment.
You know, I mean, Wolverhampton's this weekend started off. But, John, I just think you and me in Bramo at that beautiful new station.
I think the amount of pain we've put Kaylee through this week alone, that Kaylee's got to come with us too.
We'll take Kaylee with us too. And, yeah, absolutely. But, I mean, I think the Spurs need some American love. You know, we can...
Particularly from a man named Tom Keene. Is that right?
Yeah,
Is that what you're suggesting?
Think that
Have you spoken to Mr. Levy?
No, I have not, but I've talked. My people have talked to his people.
I spent yesterday afternoon trying to put a consortium together to buy this minority stake, Tom.
Did you?
Knocked back.
Did you call Elon?
Just internally. No, I was going around the desks internally and trying to raise some money, and didn't work out. Got some pushback, TK.
Okay.
Futures right now, up a tenth on the S&P and the Nasdaq 100.
It's August. It's
unchanged.
August.
It's August. Can we not start an hour by just saying it's August?
It's
Go back
August.
to bed. Come on. Yields down 2 basis points, 287.67. Sema Shah of Principal Global
Radio.
Investors.
It's August.
Joining us shortly on TV and radio. This is Bloomberg.
Certainly don't expect this rally to continue to have the same type of legs that we've seen.
The systemic risk is that we've priced in the Goldilocks scenario.
The question is the Fed actually going to be able to engineer another 125, 150 basis points of rate hikes from here?
They're going to persist with the rate hikes. They're going to persist at a slower pace, though.
The market feels it knows what the path of the Fed is going to be.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Stay in bed. That's the message from Tom.
It's August.
It's snoozy. It's
Come
August.
on, it's August.
Apparently it's
Get
summer.
over it. It's
okay,
August.
I'm over it. From New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro, together with a brilliant Kelly Lyons. Bramo back with us on Monday. Tom, futures up almost 1/10%.
Yeah.
Onwards to Jackson Hole next week.
On to Jackson Hole next week. It is August, and we're taking that today. We see it with the data, and we got the claims here in 90 minutes. John, Kit Jukes, without question, the note of this morning, buried in his note, is a great maxim. Recessions come suddenly. They come quickly. We need to respect that.
What do you think of the data so far, Tom? Does it speak to that?
No, it does not. I
don't
push
see it at
against
all.
that. And when the Bloomberg Financial Conditions Index, which I think is great, pushes against that. Other things push against it, like actual data. But nevertheless, this is a maxim that you can never forget. Recessions, when they come quickly.
Payroll's powerful. Katie Lyons, if you look at retail sales stripping out gas, pretty decent. It's on to jobless claims later.
Yeah, and of course, they've been trending upward for some time now. It speaks to a softening in the labor market that, in theory, the Federal Reserve would like to see. They would like to see a softening in many points of the economy. That is what they are trying to engineer. I just wonder at what point softer data becomes problematic, because the market is expecting that it's going to become so problematic it causes them to pivot.
You know where we have seen soft data? Abroad. Europe. Inflation still close to 9%, 8.9% CPI in the Eurozone. The data out of China, brutal. And Katie and I were talking about it earlier, Tom. The numbers you're seeing coming out of some banks right now, Nomura and Goldman, for GDP in China. Lisa talked about it before she went away. She said, can you imagine a two-handle on Chinese GDP in 22? Nomura's forecasting it, 2.8% for GDP in China this year.
You're seeing it, and also it's a time to be idiosyncratic. I've stayed away from this, John, because it's a distraction. But all of a sudden, the mother of all idiosyncrasy, US dollar, Turkish lira massively gives way. It's the Sen Bank over in Turkey looking at some real challenges, and Turkish lira is crushed. And John, it's not like Dow 10,000, but I'm sorry, Turkish lira through 18 is a huge deal for the Levant.
They are cutting rates. They're not hiking rates. Kelly Lyons, a 100 basis point cut from that central bank moments ago.
Yeah, it's interesting to see the divergence between some of the emerging economies and the developed ones, which altogether are not just hiking rates, but doing it in supersized fashion. You have Turkey cutting rates. Obviously, there's a political influence there. And I would argue there's a political implication for China, as the PBOC delivered a surprise rate cut as well earlier this week, trying to support the economy ahead of that party Congress later this year.
Rates were 14% in Turkey. They are now 13%. We'll pick up on that crazy story in just a moment. Futures right now unchanged on the S&P, unchanged on the Nasdaq. Yields look like this on a 10-year. Coming in a couple of basis points, make it 3 basis points lower, 286.40. Talked a little bit about CPI out of Europe, 8.9% in the Eurozone. Euro dollar negative by just 1/10 of 1%, 101.73. They're cutting in Turkey, Kaylee. They're set to hike again at the ECB.
Yeah, indeed they are. And Isabel Schnabel talking about needing to do it by 50 basis points once again because the inflation problem is so severe. And of course, a lot of that has to do with energy, a situation getting worse in Europe, even as some of those energy prices ease here in the U.S., which is why we've seen inflation cooling off a bit. Of course, we're not going to get more inflation data here in the U.S. today, but there is plenty of economic data coming down the pike, including at 8:30 Eastern when we get those jobless claims we were just discussing. 264,000 on initial claims is the estimate, part of just this gradual tick up we have seen in that number over the weeks, over the last several weeks, really softening in the labor market. But if we get north of 300,000, what then? That is my question. Then at 10 a.m. Eastern, we get existing home sales, likely to see a drop of nearly 5% month on month, which would be just the latest in a string of data that shows a softening in the housing market, with new housing starts dropping to the lowest level since early 2021. More data on the home builder side showing sentiment is the worst we have seen going back to 2007. All of it as we've seen the 30-year mortgage rate on average climb about 258 basis points over the last year. That, of course, has to do with tighter Federal Reserve policy. We will get some insight into how much more the Fed wants to tighten when we get speakers later on this afternoon, both Esther George of Kansas City and Neil Kashkari of Minneapolis speaking in the 1 p.m. hour. What do they have to say to clarify what exactly they meant in those minutes in the meeting when they talked about not wanting to overdo it on the one hand, but still being firm in that fight against inflation on the other, John?
Kelly, thank you. A cut of 100 basis points from Turkey. Tom, I'm still shaking my head at this.
Well,
inflation in Turkey for July. Do you want the number? 79.6%. Would you like core? I'll give you core. 61.69%.
John, what's so important here, folks, and we don't need a history lesson right now, but there are ghosts of the 1990s, which is under Keynes. When the facts change, I change. And I'm sorry, in in Turkey, they have domestic issues where the facts change, they change. John, to be blunt, why is China any different from Turkey with the way they are accommodating rapidly and daily?
A dollar lira right now, 18 through 18 and up 0.8%. That's a weaker Turkish lira. Joining us now is Sema Shah, Chief Strategist at Principal Global Investors. Sema, I'll ask the question I asked of our guest, Callum Pickering, about an hour ago. When Chairman Powell speaks, will he give this easing of financial conditions in the last couple of months his blessing?
Hi, Jonathan. Yeah, I watched that interview. It was excellent. Look, I think he has to push back against easing financial conditions. What they need is to slow the economy down. And actually what's been happening over the last couple of months, or sorry, the last couple of weeks, as the market's become a little bit more dovish, is the market has unfortunately undone a lot of the hard work that the Fed had been doing over previous months. So they need to get back in control of the situation. And that unfortunately does mean that Powell needs to play, or at least talk, a very hawkish game next week. And hopefully that will be enough to convince markets of what they actually mean. Whether or not the market listens, I think, is a different question at this point.
On Bloomberg Radio, it's always important to understand we tell a guest by their bookcase, and with Sema Shah behind her left shoulder, she's got Ben Bernanke's The Courage to Act. What is the courage that Chairman Powell needs to act right now?
Look, he has to do two things for me to change this. One is that he has to acknowledge that the economy is slowing and it's likely to slow further. And then he has to say that despite slowing economic growth, they still have to continue raising rates. And they have to do that because containing inflation is really, I know they have a dual mandate, but that is the number one priority. Inflation can completely ravage an economy, and they have to get a grip of that. And I think that's what we need to hear from Powell next week. And certainly actually over the coming weeks and months as well, is to continue reiterating that message. Unfortunately, that is going to do damage to both the market and the economy.
Which asset class do you think he needs to speak most directly to, though, Sema? The bond market or the equity market, considering a lot of the rally we've seen seems to be based on the fact that yields have moved lower?
I do think that they need to talk to the equity market. Look, yields are moving lower because people are concerned about the risk of recession. And I think that the risk of recession, I mean, there is a split in a way between the equity market and the bond market. The bond market is very negative about the growth outlook, whereas the equity market seems to be very optimistic about pretty much everything. So it's really directing it at the equity market, and that is where you're getting the easing of financial conditions in the past month.
Sema, is there anything you do like in this market right now?
I do sound negative. Yes, I think that the point at the moment within the economy is that inflation has peaked, but it's going to slow down very, 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 very slowly because parts of the labour market continue to be quite strong. So if inflationary pressures are still with us for some time longer, it is very important to maintain exposure to real assets. We think that real assets can continue to do well. We would focus mainly on infrastructure. Infrastructure typically outperforms in a slow growth, high inflation environment like we're entering into. And that's where, there are opportunities everywhere, but essentially it's real assets which have the best opportunities.
Sema Shah, also to catch up from Principal Global Investors on a tricky market as we all wait for Chairman Powell. Tom, is it that ridiculous? Does it all come down to one thing?
No.
Whether Chairman Powell says, we like it, we don't like it, it's okay, it's not okay?
We're going to have to see, and I think it'll be the data. You know, frankly, claims here at 8:30 this morning is just as important as a single sentence in his speech. What I would say it's like 100% certain he's going to tilt towards data dependency, even though we're going to get forward guidance from George and Kashkari today. John, we have had an historic surveillance response on Twitter to the need to go see UVA and UNC after the FOMC special show.
Okay, this is basketball.
It's a Leaves change. This is football, John. We do Central
football.
Park, the FOMC.
When's it basketball?
November 2nd.
It also starts in November. This is where it gets
I didn't think those two colleges were good at football. I think
they're
good at basketball.
They're terrible at football.
They're
but
good at basketball.
You go, John, to look at the
Thank
damn
you.
Leaves.
Okay.
You go to look at the Leaves.
But why don't I want to go watch two really bad colleges play football?
Because it's the Leaves, and you get to sit on the, what do they call it, Kaylee? The green where only fancy seniors get to live. Lori Calvasino lived there. The lawn.
Yes. The lawn.
It's not like Frisbee. It's not like you don't play Frisbee on the lawn.
Shouldn't we go and watch Bama against Auburn?
No, the Leaves don't change down there. They stay green forever.
They're good at football, aren't they?
They're too good at football. That is my problem.
We want to go and watch good teams.
John,
I thought we liked winners in America. What's this about?
No,
we don't like
surveillance.
Bama,
We
don't
like losers.
Brady.
Yeah, don't like Brady.
John, when you're in the triple leveraged all cash fund, you like losers. Stay with
Do
it.
we like the Yankees?
Afterthought up early this morning.
So we love the Red Sox.
We like the Red Sox. Speaking
Because
of
they're
losers.
Okay.
John, Afterthought emails in up early. Good to see her studying, getting ready for the fall. And she says, tell Mr. Ferro chlorophyll or a lack of chlorophyll is why the leaves break down.
It's taking me back, Tom.
There you go.
And then
nice science lesson for a Thursday morning.
Andrew Sheets, if you're watching, you can reschedule. He's set to join us at 8 a.m. Eastern time, so about 50 minutes from now.
Come on, John.
From
Road
Morgan
trip.
Stanley.
Central Park to Charlottesville.
I don't want to watch bad football.
I'll make a great playlist.
We can go to Bama. I think that would be awesome. Down to Alabama, Tom. Go and watch Bama play football. I'd
Have
love
fun.
to do that.
Won't see you there.
Futures, positive a
It'll
tenth
be
of
a Ferrell
1%.
remote.
From New York City this morning. Good morning, Alabama. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The US and Taiwan are following through on a long-time promise to deepen their ties despite opposition from China. The two countries will start formal talks on a trade and economic initiative this fall. Still, a trade agreement may be more symbolic than substantive. Both Republicans and Democrats have been reluctant to embrace free trade agreements. In the UK, the so-called summer of discontent is about to get worse. Britons face some of the most widespread disruption yet due to strikes by rail workers and bus and subway staff. That'll be followed Sunday by an 8-day strike by dock workers at Felixstowe, the biggest container port in the UK. And traders are betting that the Bank of England's key rate will soon overtake the Federal Reserve's. Market-implied projections of where the UK's key borrowing rate will be 1 and 3 years from now have overtaken US equivalents. The flip in pricing was triggered by hotter-than-expected UK inflation data Wednesday. And in China, the number of COVID cases has surged to a 3-month high. It's being driven by an outbreak in Hainan province. That's the biggest since the spring. There were more than 3,400 new infections reported on Wednesday. More than 2,000 medical workers have been brought in to Hainan to help. And more legal problems for former President Trump. The longtime CFO of the Trump Organization, Alan Weisselberg, is expected to plead guilty today to tax fraud. Bloomberg's learned that he will not implicate the former president, but he will be required to testify against the Trump company. And experts say his admission of criminal conduct could mean trouble for the business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I have worked in the Obama administration. I've worked in federal policy, now as a member of Congress. And I'll tell you, it's not wave a wand, but it's get a bill done. And that's what you're seeing here. I call this President Biden's South Carolina moment, right? Because you got a gun safety bill done, a chips and science bill done, and now this Inflation Reduction Act.
Congresswoman Haley Stevens there, the Democrat from Michigan, from New York City this morning. Good morning, Tom Keene, Kelly Lyons and Jonathan Ferro. Bramo back with us next week as we count you down to Jackson Hole, Wyoming, and the Fed's annual symposium. Futures positive 0.1% on the S&P 500, on the Nasdaq up a little more than 0.1%. Yields in about 3 basis points. Let's call it 286 on a US 10-year this morning. Bit of news from the team again. Ruth David and David Hellier here at Bloomberg News, leading some of the reporting around Manchester United. Reported just yesterday that the Glazer family may sell a minority stake in the Premier League football team. Now confirming what has circulated already this morning, that buyout firm Apollo Global Management has already expressed interest, according to a person familiar with the matter. Tom, UK businessman Jim Ratcliffe, another name in the mix, while Tesla chief executive Elon Musk joked about the deal, Tom, just joked about the deal, but hasn't signalled actual interest.
Are you
in that
surprised that
stake.
Apollo-type people are involved?
No, not surprised, and not surprised that Jim Ratcliffe's name's in the mix as well. It was in the mix around the Chelsea story too.
Okay, very good. We turn now to a reality for every news organization, and that there are foreign correspondents in harm's way at any moment. And then there's a moment where you're sitting at your desk and the phone rings and your life changes. That did for our Anne-Marie Horton, who speaks now of very bad days. An important article in Bloomberg Business Week, an article barely describes, Anne-Marie, what you went through in extricating people from Afghanistan. What was it like, that first phone call from Anastasia Ellis?
Well, it was heartbreaking and also a little bit confusing because I didn't really know much of what I could do. But she was very upset. She's a good friend. She's an incredible mentor and manager. And this was someone she had just hired. And I spoke to him. And, you know, he went into a conference room to really tell me what the reality was going to be like for his family. So I said I'd make a few calls. And then I got a group of individuals in Bloomberg, and we worked on this together. It was a massive team effort, and it would not have been possible, obviously, without the backing of the company and the founder. And it's incredibly eye-opening, which is why we thought we should write the story, because it's reflective, even with this family, with all their support, reflective of how difficult it is, and this crisis is only getting worse.
Right from the family, there is a triangulation of Afghanistan, obviously the U.S. and Europe, and Pakistan. I think the most important thing from a reporting standpoint is, what did you learn about the odd place Pakistan fits within the greater sets of the stands?
Well, when it comes to this crisis, Pakistan is just overwhelmed. What's going on in Afghanistan is so dire that most people are fleeing, and they go to neighboring countries like Iran or Pakistan. Pakistan has over 1 million, at least, refugees from Afghanistan at the moment. But what I have learned with a number of refugees that were fleeing and were able to get asylum, Pakistan was helping these people leave, even though some of their documents weren't in order, or they didn't have the correct visa, which happened with part of the family members I was working with. Pakistan was able to set up these government interviews, interview people, and make sure they were cleared, and working with all of these host countries, whether it be Greece, Canada, the United States, the United Kingdom. A number of Afghans are still in Pakistan living in limbo, and the Pakistani government has a crisis organization that is working to try to act as this human corridor to get these people out to safety. Now, there are others that are living in camps on the border, and that's a very different path forward for them.
AMH, as you know, our attention shifts and pretty quickly from one crisis to another. And a year later, many of these stories have been totally forgotten. AMH, we often forget also how many refugees there are now around the world, and how there is very little process agreed on how to deal with any of it. AMH, what have you learned about that process now, and what are they doing about it?
There's lots of no's, there's lots of false hopes. There's not one unified process around the world for refugees, which is why they live in limbo, so many of them. And what we do know is that a number of countries are taking on, they have these schemes, but they're still not even close to what they promised. In the United Kingdom, you have about 10,000 Afghans still living in hotels. The United States, by far, in terms of a program, is offering the most. 81,000 Afghans have come to the United States, but if you don't have a special immigrant visa, your path forward, how do you stay here, is very complicated. And this is just Afghanistan, Jonathan. What was so obvious when Russia invaded Ukraine is just the mass flow of refugees Europe again was going to deal with. Syrians have fled to Europe, Afghans have fled to Europe, and then Ukrainians. And these countries are dealing with their own domestic politics. So it's going to get much harder to get that aid and to get that support to these individuals who are seeking asylum.
But on the subject of aid, Anne-Marie, the U.S. and its allies are giving direct aid to Ukraine. The aid flow to Afghanistan has stopped entirely. And as the humanitarian crisis worsens there, is there going to be political pressure for that to change?
There already has been political pressure, not so directly from the United Nations, but directly from others, that the United States should loosen some of the grip on that aid. We should note there is still humanitarian aid going into Afghanistan, but it has to go through UN agencies. Nothing can be given to the Taliban. But Kayleigh, as you mentioned, before the fall and the collapse of the government, more than 40% of the Afghanistan government's GDP of being able to keep the country operating came from international aid. Now that you have the Taliban in charge, it's global isolation, it is sanctions, and there is no money. You even have Afghans so desperate, if they're not fleeing, selling off their young daughters so they could feed the rest of the family. And the winter's only going to get worse. And we talk about high inflation in the West. The UN says that in Afghanistan, it's 40% higher for food and energy, and they're going to be going into these winter months. So it's a very dire situation, and there's been a lot of pressure to have these talks between the United States and the Taliban to try to loosen up some of those funds, because $9 billion is stuck. But the central issue that potentially the Taliban needs to confront if they want some of these funds is women's rights. Women are again living in 1990s Taliban. Girls cannot go to school past the 6th grade, and they are being forced to cover up. They cannot go out in public without a man, and this is the central issue that the international community wants to continue to put pressure on if they want those funds.
Anne-Marie, you truly are one of the hardest working journalists that I know, and it's fantastic to catch up with you today. And as a friend and colleague, extremely proud of the work that you've been doing. Anne-Marie Hordern down in Washington, D.C. And if you have not read the piece in Bloomberg Business Week this week, How a Bloomberg Reporter's Family Escaped the Taliban, authored by Anne-Marie, and really revealing Anne-Marie's role in that massive effort that's taken place over the last 12 months. From New York City this morning, good morning with Tom Keene and Kenny Lyons. I'm Jonathan Ferro. Futures up about 0.1%, an hour away from jobless claims in America. This is Bloomberg. Tom is so bored this morning, he's talking about autumn, or fall, as you might say.
Autumnal
When
thoughts.
the leaves turn brown and fall, and TK can't wait, apparently. OK, futures unchanged on the S&P 500, unchanged on the Nasdaq as well. Yesterday, deep day of losses.
Do the leaves not change in the United Kingdom?
Snapping a 3-day winning streak on the S&P 500. They've changed, TK. But, Tom, when you lived in the UK your whole life and experienced summer that lasted 2 weeks, and you move to America and you get summer that lasts about 3 months, you mourn the end of summer. You don't celebrate it.
Guys,
And of course, the winter here is brutal, Tom. You know the winters here is brutal. It lasts about 5 months. So why would I be happy about
I just thought I saw a movie once where Disraeli went up to Scotland and the leaves had changed.
Well, the leaves change throughout the whole country, Tom.
Okay.
Wait, what? I'm lost.
Okay.
I'm very, very lost.
Do the data check.
Take a beat. I'm going to move to the bond market.
Move to the bond market.
2s, 10s and 30s. Yesterday, we came really, really close to the highs of the year on a 2-year yield. 337, intraday high 345. That's the intraday high for the year at 345. 337 was the move yesterday. Then yields backed away after the Fed minutes. Yields back down to about 326 right now at 326.43. Down a couple of basis points on a session. On 2s, on 10s, we're down 3 basis points to 286.94. TK, to wake you up,
Please.
dollar lira, OK? A move through 18.
Turkish lira, not Italian lira.
A rate cut. I've got to go back until for the last time we were talking about the Italian lira on Bloomberg, Tom. Anyway, a breakthrough 18 on dollar lira, a rate cut of 100 basis points. I miss Silvio Berlusconi in that football club, Tom. We had some special times.
I'm sure you did.
Dollar lira. Not me personally. I'm talking about the success. I'm talking about the success of the club. This hit is down in flames, isn't it? Dollar lira up through 18, a 100 basis point cut with inflation, somewhere like 70, 80%
right.
year over year. You don't get to speak again. We're done. All right? That's the cross-asset price action. I can't let this go down in flames anymore, Tom. We're going to have to get to Katie Lines for some news. And some news.
I'll bring the hose.
Hey, Katie.
There's a number of actual fundamental movers to keep an eye on this morning, all related to earnings. One of them being Wolfspeed, which is the big semiconductor manufacturer, handily beating expectations when it comes to their revenue guidance. Plus, they're investing in more capacity. And all that together has the stock up 21% before the bell. It also was a beat on the guidance for Cisco Systems, the big IT and network software computers maker. It also beat expectations when it comes to revenue. The thing there is that the semiconductor shortage is easing, and that is allowing them to actually have more supply to meet demand. And as a result, it's up 5% before the bell. You also had a profit beat for BJ's Wholesale, higher by nearly 6%. Then we got to talk about the not-so-fundamental moves, and what I mean by that is the meme stocks are still the ones that capture my attention. After a 400% rally since late July for Bed Bath & Beyond, we're seeing it give back some of those gains this morning, down about 13% on a filing from Ryan Cohn, the company's almost biggest shareholder. He may sell that entire stake, up to 7.8 million shares, maybe cashing in on that astronomical surge. So that's why that stock is down, but really just some air being let out of the meme trade more broadly. GameStop also lower by about 2.5%. Finally, I just wanted to mention Apple as well. The stock is down about 0.3%, so a little bit of pressure coming into some of those large cap tech names. But of course, Tom, set this date on your calendar. September 7th is when you can go learn about that new iPhone 14.
It's going to be interesting, the 14 Pro with the new chip. I'm very chip-centric, and the 14 Pro is going to have a new bionic chip in it, which is always a step forward within their product development. Kaylee, thank you so much. What's important is to watch flows, and when it's August and it's slow, flows really matter. Emily Gaffeo over at our asset division reporting today on a massive switch in flows that we've seen in the equity income, and this is all wrapped around quality. The search for quality is seen in flows. Kelsey Barrow on the bond side, fixed income portfolio manager, JP Morgan Asset Management. Emily Gaffeo was looking at the equity market. What do you see in flows in bonds? When you and Bob Michael look at the screen, what do flows look like?
Yeah, so we've seen some pretty large moves within the fixed income market over the last few months. So if you think about what the market was pricing in terms of recession probabilities implied within BBB spreads or the equity market, it was as high as around 80% in mid-June. Now that's down to about 40%. So we've seen a very large retracement in high yield spreads down to the mid to low 400s. And what we feel in terms of that movement is we understand why there's been a repricing. There is an increased probability of a soft landing. But at this point, this level of spread is really no longer protecting you from the still material risk of a hard landing if inflation remains stickier, which is our base case.
Okay, Kelsey, so where does that leave the Treasury market and how that's priced right now? Are you more comfortable with that? Chris Harvey of Wells Fargo wrote this in the last 24 hours, that April's 5 basis point inversion seemed to have got more attention than the almost 50 basis point inversion we had last week. Why do you think that is?
Well, we've been positioned for curve flatteners. I know I was last here on July 6th. We were calling for higher front-end yields on a flatter curve. The 2s, 10s curve is now 30 basis points flatter. And we think that that makes sense. The Fed has done 2 supersized rate hikes. Now what we're looking at, so the market is pricing in the Fed funds rate getting to around 3.5% by the end of the year. That's basically in line with the Fed. The real divergence comes in 2023, where the market is pricing rate cuts and the Fed is expecting to continue to hike. And I think the minutes gave us some insight into that. I noticed one of the things that that stood out to me was the fact that there are a number of people on the committee that expect that once they get the policy rate to restrictive, they're actually going to need to keep it there for a period of time. And we are lean on that side, expecting that the Fed is going to need to keep policy rates higher because although we got one decent inflation report, we're still seeing a lot of wage pressure. And one of the data points that we thought really was underappreciated last week was unit labor costs, productivity adjusted wages, which is also still very strong.
Relative to previous cycles then, Kelsey, previous hiking cycles, how much longer do you think they're going to keep it at that terminal rate, that peak rate at the Fed in this hiking cycle relative to cycles gone by?
Yeah, so we looked back at the last 4, 5, 6 hiking cycles, all kind of the modern hiking cycles that you'd think of. And a couple things stood out to us. One, the Fed never stops hiking rates when the real Fed funds rate is still negative. So just to put it out there, the real Fed funds rate is still minus 6% if you deflate it by headline CPI. So they still have a lot more to go. But in terms of how long they're going to keep policy and restrictive, on average, we see that the Fed keeps rates at that terminal rate for about 7 to 12 months, so about a year. And we think, given the magnitude of the inflation problem, given the fact that the unemployment rate actually continues to tick down despite, we'll watch initial claims later this morning. And so we expect them to be more in line with the historical average of the last 4 tightening cycles.
Well, while we're looking back at history, let's talk about the 70s as well, because I noticed some research out of Barclays on credit earlier this week, essentially saying when you look at this inflation and growth environment, it's most akin to 1973 to 1975, 1978 to 1980, both periods which were not good for credit. And they say this time isn't going to be different. Will it?
We are a little bit more cautious on specifically high yield, given the retracement we've seen. There are probably some things that are going to put some resistance below 400 on high yield spreads. One, we do expect that issuance is going to start picking up. Also, if you break it down between the categories within the high yield, one of the areas where you're going to really need to see a lot of retracement to get spreads materially tighter would be triple Cs. And these lower quality companies are starting to feel the pinch of higher prices, higher interest rates. And so, where we're more focused is in short-dated investment grade credits, or higher quality, as well as short-dated securitized credit. These have better break-evens. They have better all-in yields. We can feel more comfortable with the credit quality. And if you look at how they've performed in this rally, they've kind of lagged relative to the U.S. high-yield market.
Where would high-yield spreads need to get to in order for it to look attractive?
Well, back in June, we got around 600, and at that point, we thought that we were at least starting to price in and get compensated for those risks of a harder landing for an increase in defaults. Now, I don't want to ignore the fact that on a high level, credit fundamentals are still extremely strong. We're starting from a very good point for both investment grade and high yield companies, high cash balances. They've termed out their debt. Their leverage is on track and looks good. Relative to pre-COVID. But we do have to realize that where we are in the cycle, things are going to deteriorate from here. Margins seem to hold up actually better in this last earnings report, but we do see that's not something that's going to be sustainable as inflation pressures remain.
Kelsey, just awesome, as always, and wonderful to catch up again here in New York. Kelsey Barrow there of JP Morgan Asset Management. TK, I'm so pleased Kelsey is happy to lead the way on this conversation about how long we'll be at that peak rate for. That's the big debate for 2023. We've got to talk about it.
The debate from Bruce Kasman on down to what they're doing in bonds at JP Morgan is simple. It's all about the x-axis, and that's a mystery. And I'll be honest, frankly, Jackson Hole can provide some clarity there. But to me, it's the duration of where rates are as much as the level of rates. And it's good to see people writing and thinking
Couldn't
about
agree
that.
more. Alan Ruskin of Deutsche Bank did some stuff on that, Tom, in
Yes,
the last couple of months. Last 3 Fed cycles then, time spent at peak, 7 months in 2000, 12 months in 06-07, 7 months in 2018-19. And Aline, listening to Kelsey Barrow there, Tom, that perhaps it's closer to 12 months this time.
Well, 12, nobody's pricing that in. We've got this parlor game of like when they cut rates. I'm looking at Taylor rule models, which I understand everybody thinks the work of John Taylor is antiquated. I'm sorry, the diversions here, as Kelsey mentioned, John, are so still substantial that time is the only thing that helps ameliorate that.
I just can't forecast next week, Tom. Never mind 12 months.
Well, the foliage next week is south of Algonquin Park. It's not quite to Toronto. It's like down from Bartlett Lodge.
What's this about?
The foliage next week
Are you
is
taking
down.
time off in the fall? Is that what this is about?
He's trying to find peak leaf beauty for his pictures with the moose.
For his vacation.
Yeah.
And is that why you asked about whether we'd ever seen a moose a little bit earlier?
Yes.
Yeah.
I just don't get it. Futures up 2/10 on the
I saw
S&P.
one off 102nd Street once. It
Yields
was
down
just
3
out there.
basis
That
points.
bill scared it off.
286.58. You saw a moose.
Yeah, there's a moose in Central Park, John, up north.
All right, I'm done.
Away from the Harlem.
No, we're done. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China is lashing out at a $52 billion program to expand American manufacturing of semiconductors. An industry association says it contains elements that violate fair market principles and targets China's own efforts to build a chip-making industry. The legislation prohibits companies that receive funding from expanding production of advanced chips in China. Meanwhile, China plans more fiscal stimulus as the economy's outlook gets worse. State media said local government could sell more than $229 billion of bonds to fund infrastructure investment and plug budget gaps. Both Goldman Sachs and Nomura have cut their forecasts for GDP growth in China. Shares of Kohl's are falling today. The troubled department store chain slashed its outlook for the full year. Kohl's says its customers have been hurt by inflation and it's taking steps to cut inventory and lower expenses. The American owners of the iconic English football club Manchester United may sell a minority stake in the team. Bloomberg's learned that a buyout firm, Apollo Global Management, has expressed interest. British businessman Jim Ratcliffe is another name in the early mix. Manchester United fans have called for a change in ownership because of the team's disappointing performance in recent years. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I would bet in the next 6-12 months, you see zero goods inflation globally in the U.S. And I think that's a big deal. Obviously, services inflation is sticky, but I think that will give the Fed some optimism to slow down the pace of hikes.
Mike Collins there of PGIM, just like Kelsey Barrow moments ago, turning a little bit more conservative, less constructive on high yield credit in the last 24 hours. Good to catch up with him, with Tom Keene and Kenny Lyons. I'm Jonathan Ferro. Bramo back with us on Monday. Here's a snapshot of the price action this Thursday. Equity futures up around about 0.2% on the S&P. On the Nasdaq 100 up 0.2% also. Yields lower by 3 basis points on a 10-year, 286.40. If you want some price action in the FX market, dollar lira, a move of 0.7%. Not a major move for that currency pair, but a big move from the central bank. The central bank cutting interest rates by 100 basis points with inflation year over year running at something close to 80%, Tom. That's what's happening in Turkey.
That's what's happening in Turkey and original challenges in China as well. Let's turn to that right now. Enda Curran with us, Bloomberg Chief Asia Economics Correspondent. And I want to put the political overlay on what we're watching within the Bloomberg world. There is a summer conference. I'm going to let you decide where Badahe is, but it's really private, really secret, in a totalitarian regime, and then they dash to November, October, and the party Congress in November. What is the body language at this important secret summer conference, given the set of crises China faces?
Well, we might get some indications, Tom, from the state press over coming days in terms of what went on there. Basically, that's a gathering of the top Communist Party officials. It happens every summer on that East Coast beach resort. This time around, it's thought that the conclave was actually happening when Speaker Pelosi was in Taiwan, which certainly would have made the conversation interesting. It does appear to be over because President Xi and Premier Li are both out and about now again. They're getting photographed, and Premier Li's making comments about the economy and what needs to be done. But in terms of the broad sort of policy discussions that went on there, it will take a little while for it to start dribbling out through the state press. But it will start to emerge over coming weeks.
But the difference, Enda, is they used to do photo shots at Badahe, floating in the sea, you know, swimming, romping around and all that, with 8% GDP. John, what is it, 3% GDP at
the
Goldman
forecast
Sachs?
from Goldman's 3. Over at Nomura, it's 2.8, Tom, for this year.
Enda, there's got to be a different chemistry now, a different urgency.
There is an urgency. You can see that in the language. We've had some news today about how local governments have got to get on with spending money on infrastructure They're talking there about 200 odd billion US dollars worth. So there is a degree of urgency there, Tom. The language as well from the officials, Premier League the other day, talking about how the economy has slowed more than he thought. And they are definitely going to keep an eye on what's happening with youth unemployment. So it's not going according to plan. Remember where we were at the beginning of the year. The growth target was 5.5%. Omicron had not yet hit China. It was meant to be this year of stability for President Xi and everything else, but at least on the economic front, it is challenging him on all fronts. And I think we'll have to see where they do pivot on the policy front between now and the end of the year, because the investment houses continue to downgrade their growth forecasts, so the pressure is real.
Do you remember was it the New Zealand Central Bank, Tom, maybe 8 years ago, at the height of what people described as a currency war, and they talked about bringing a pea shooter to the currency war? Pea shooter to a gunfight, and is a 10 basis point cut a pea shooter? Does that make a difference from the central bank?
No, and I'm sure they probably wouldn't claim it would, actually, if they were to be frank about it. It's more about the symbolism and the optics. They're clearly just doing what they can do on the central bank side of things, which is try and bring down interest rates and put some more money into this financial system. But as we've discussed before, there's no shortage of credit in China's financial system. The cost of borrowing is not a problem. That's not the issue. The whole story is more about either structural in terms of what they've done to the property sector to rein in debt and leverage. And of course, then we have the ongoing disruption from COVID-0. So the central bank rate cut this week in and of itself is not going to turn things around. That's why people today are talking about this fiscal spending that's coming up. Even that money, by the way, today, it's not clear if it's new money. They're still somewhat disciplined, but that's where the action is going to come on the government side of things.
Yeah, how much are policymakers in China held back by the fear of inflation, Enda? Because I think it's so interesting that we're seeing all these stimulative moves in the last several days, when last week the PBOC was out saying, hey, we're not going to overdo it because of the risk of inflation.
Yeah, it's a really interesting question, because again, on a headline basis, there really hasn't been inflation in China, not at consumer level. There certainly was sky-high factory prices and producer prices last year that was impacting factory costs, and there was some debate about how much of those costs then were flowing overseas in terms of all the merchandise goods. But the producer price story is easing up. Consumer prices are actually higher at the moment, but that's mostly due to pork prices. There's a lot of distortion there in terms of the basket, in terms of how it does get skewed by food and veg prices, in particular pork. You're right, the PBOC did come out and say, we're worried about inflation, but they're trying to sell themselves these days as something of a Bundesbank of Asia. They're critical of QE, they're critical of the Western approach to the response to the financial crisis, they're critical of, lax fiscal and monetary policy standards. So they're trying to be seen as this kind of model paragon of probity. But while they're warning about inflation, there's no real sign of a major broad-based inflation outbreak in China just yet, anyway.
And you are one of the best. Thanks for your time late into the evening over in Hong Kong. And Karen there, as we break down some of the latest moves on the political front, the policy front, and also just looking at some of these forecasts, Tom, they are unreal. Just to see 2.8% as a number, as a forecast from Nomura for GDP in China, and 3% from Goldman, down from 3.3.
The cardinal rule, social rule, John, of their pressure to employ people has always been 6%. That's been the run rate. And the path from 6 to 3 is way more than 3 percentage points less GDP. On a social basis, it's titanic. And as we have in our articles today on Bloomberg, the youth unemployment, maybe that's a new thing to talk about. John, amid the gloom, can I just suggest how far we've come, and on the record high watch? We're really, we're not going to do it today, but on record watch here, SPX up another 12%, Dow up 8%. NASDAQ's got a long way to go, but I'm looking at the Bloomberg screen with Dow 34,000, SPX almost to 4,300. Things aren't that bad.
Things aren't that bad relative to what, Tom? Middle of June? I agree with you.
We've come a long way. You've talked about up 17% in that.
Well, we've taken back more than 50% of the drawdown on the S&P, haven't we?
Yeah, but let's look at the gloom that we've heard this week. The gloom is off the chart.
Well, the gloom was off the chart in June. And I think there's good reasons, Tom, for the gloom. You've got a central bank tightening into what many people think will be weakness, and not just weakness here in the States, but weakness worldwide. If you ask anyone in Europe right now, they're anticipating a recession potentially in the second half of this year. And we've just had a conversation about the world's second largest economy dropping to 2.8% GDP growth potentially.
They could fix it in tomorrow if they did a COVID policy. Is that really the step here? Is like magic, somewhere before the party Congress, we're going to see modern medicine find China on COVID?
It's a piece of it, Tom. It's a piece of it. But they also have to confront what is looking like a balance sheet recession as well. So yes, I agree with you that if you get rid of COVID zero, you get a snap back in the economy, Tom. But they've got other issues around the mortgage market, around the housing market.
The commercial real estate market has been cyclic there, John. And if with all my history here, it's up and down, and now it's a new level of down. No question about that.
Futures right now up 0.2% on the S&P, on the Nasdaq 100. We're up 0.2% also. In the next segment, we'll catch up with Andrew Sheets of Morgan Stanley and maybe do a little bit more on the seasons, Tom. The seasons and the changing seasons.
Well, you know, he was at Brown University and the leaves changed.
I'm sure he's
there,
got things to say. I still don't know how we got into this conversation.
Tom just wants a pumpkin spice latte.
It's August, John. It's August. You look forward to September. You know.
Much of the bad news that the market had to grapple with in the beginning of the year has already happened.
We are in a situation where demand continues to remain high.
The inflation stickiness is not going away anytime soon.
I would bet in the next 6-12 months, you see zero goods inflation globally in the U.S.
This inflation story is still evolving.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. Bramo using my vacation days. Kaylee Lines pulling the short straw this morning and joining us. John, Andrew Sheets coming up. His note is absolutely brilliant on how the Fed pivot will stop this bull market.
He does not think we'll get that durable pause anytime soon. He's skeptical of the rally that we've seen, and that's been the team over at Morgan Stanley now, Tom, for quite a while. But this rally, it's long in the tooth now, isn't it, TK? It's a move of about 17% off the lows in June, and this Federal Reserve has at times pushed back and said we've got more work to do, and this market has carried on fading that story. Next big stop is Jackson Hole next week.
Well, Jackson Hole next week, and I wonder if when Powell speaks, obviously he's central banker to Wyoming and the United States of America, but how does the international scene color what he will talk about? We see that this morning, John, in the shock of Turkey, and far more importantly, the 3% shock of China.
If he starts talking about the rest of the world, a lot of people, Tom, would interpret that as dovish, because there isn't a good story right now to tell about the rest of the world. For that reason, I imagine he might avoid talking about the rest of the world, because inflation's still running pretty high, Tom, even with the decline of the last week or so. They've got work to do. They keep talking about it. The difference, though, in County Borough of JP Morgan 30 minutes ago was brilliant at this. The difference, the spread between where the market is now and what the Fed is telling you is what happens in 2023. The Fed, in the minutes, is telling you that even when we're done hiking, and we think we're going to hike some more in 2023, we're going to stay there and stay there for a while and watch and wait and see what happens. The market's saying once you're done, you're going to start cutting.
And Kaylee, what Kelsey talked about, which I've been screaming about, is look at the x-axis, and this is extending out. Kaylee, within what you read, is it matter 50 or 75 basis points, or what really matters is the duration of a rate hike sequence?
It's the destination and how long we stay there, Tom. I think we've all gone back and forth on this volley between the size of rate hikes. We know the Federal Reserve said yesterday in the minutes they are going to slow them eventually. It's to where they get to. It's less about the journey as it is about the destination. And clearly there is, it's like a road trip through fall leaves, Tom.
Don't give him encouragement. Don't give him encouragement. For people just tuning in, TK obsessed with climate and the change in the seasons and the brown leaves and when the leaves start to fall.
The brown leaves, you give it away. No one calls it brown leaves.
You call it the golden leaves.
We'll get to this in a moment. Let me do the data check. I'm going to start with Turkish lira through Dow 10,000. Turkish lira above 18, showing the challenges of a frontier economy.
A 100 basis point rate cut from the central bank off the back of inflation close to 80%. If you don't get it, many other people don't get it either. Elsewhere, futures positive 0.25% on the S&P 500. Yields in TK down 4 basis points, 285.67. Your next stop, jobless claims, 27 minutes away.
A lesser curve inversion, we go from negative 49 basis points. We got to negative 39, a lesser negative number, negative 37 right now. That's a big deal. And I do want to show the Bloomberg Financial Conditions Index. That's a pro statistic, folks, but what it really shows is the great accommodation that we have seen. Andrew Sheets is chief cross-asset strategist at Morgan Stanley. He has to synthesize together, piece together all of what Morgan Stanley is doing. Andrew, I'm going to suggest in August your head is spinning. We've got to get from August to September. What are we going to look like in September?
Well, thanks, Tom. So look, I do think markets are in this interesting
pause, this interesting quiet before you have a lot of incredibly important events that are all arriving in September, October, right? We have an important Fed meeting in September where we think the Fed's going to hike another 50 basis points. We have inflation that's going to be coming down, but we think it's going to be coming down slower than probably the Fed would like. And then you also have a very important earnings season where we think the numbers are going to get reduced further into third quarter earnings. So I think at the moment, the market has been getting some relief from the fact that inflation's been a little bit better. Sentiment was very bearish. You've had some better than expected economic data. But I don't think these issues have been resolved, and we still think that the Fed has more to go, and then also will ease policy less next year as they want to stay serious about inflation.
Andrew, at times, and I'll say this for you, I think you and the team have unfairly been described as perma-bears. You weren't in 2020, in spring 2020. In fact, you were out front saying, let's buy this market, let's go, let's go, let's go. Can you tell me the difference between now and then? Because for a lot of people, they're conditioned by that experience, Andrew. They just remember people telling them, don't buy this, don't buy this. And then we got 40% down the road off the lows and they realized they'd missed the rally. Andrew, what's the difference between now and then? What are the signals that were triggered then that you said buy that aren't being triggered now?
Yeah, thanks, Jonathan. So I think there are a number of really big differences. I think in early 2020, after that market decline, you had a lot of very early cycle signals. You had very depressed economic data, very depressed sentiment, importantly, very easy monetary policy with very low inflation. Remember, we had that kind of infamous negative number traded for a barrel of oil. And you had very low valuations, or much, much lower valuations, all those things coming together, a lot of things that you usually get kind of around a recession. Now, I think as we kind of fast forward to today, I mean, valuations aren't necessarily expensive on all asset classes, but they're nowhere near as cheap as they were in early 2020. But I think more importantly, the monetary policy backdrop is night and day. It's gone from kind of whatever it takes response to an unprecedented pandemic to one of the fastest paces of rate hikes that we've seen in the last 30 years, and attempting to get in front of some of the highest rates of inflation we've seen in the last 40 years. So I think it's that resolve from central banks, especially the Fed, that we think continues. That's one of the big differences.
So, Andrew, all of that makes logical sense, and yet we've seen the return of the meme stocks in recent weeks. Speculative behavior that we all thought was going to be long gone in an era in which central banks are tightening policy. What kind of signal does that send to you, and how hard do you think the Federal Reserve is going to have to push back against that kind of behavior?
Yeah, thanks, Kaylee. So this is a great question. I mean, anytime you're on the more cautious end of the spectrum and you're incorrect about that, I think as we've been over the last couple of weeks, you do need to think hard about that thesis and if you're missing something. And I think if it was a rally that was being led by new leadership, cyclical leadership, a sign that we've had the worst of the slowdown behind us and things are going to reaccelerate, I think that would actually be a very encouraging sign. I mean, I think that would be the sign that this really is a mid-cycle slowdown, or we've already had the sell-off off a recession. But I think the reemergence of some of the biggest beneficiaries of low rates, zero rates, quantitative easing in 2020, 2021, that doesn't feel like kind of a new cycle starting. That feels a little bit more like shorts being squeezed, investors being fearful of missing out, sentiment maybe not being as depressed as we otherwise might like to think. So I also think from a Fed perspective, the Fed has to think about financial conditions, and its goal is to tighten financial conditions. And so again, as we've seen stocks bounce back, and as we've seen some of the most speculative areas of the market bounce back, that's going against one of the things the Fed is trying to accomplish.
So Andrew, when do we get the wake-up call? What's the wake-up call look like? What are you anticipating? Is it one speech from Chairman Powell next week in Jackson Hole, Wyoming? Is it the data? What is it?
Yeah, so I think it's a number of things I think we need to look out for. And again, I do think this upcoming window for markets is pretty important. I think if worse things are going to happen, or if trouble is going to emerge, it's going to happen in the next 2 months, or it's not going to happen. So I think that trouble would come from inflation not coming down as fast as expected. So the upcoming CPI, especially core CPI, core PCE, not declining as much as the Fed would like. I think that would push the Fed and push the market to remove their rate cut expectations from next year. And we like pushing against those rate cut expectations next year. We also like being long the dollar for those reasons. And then it's the earnings data. I mean, this has been something that my colleague Mike Wilson in the US or my colleague Graham Secker in Europe have been very focused on, is a view that the earnings expectations they think are too high. Now, the third quarter is often a relatively weak quarter seasonally for earnings. That's often when companies come out and take guidance down. We'll see if that happens again. But our expectation or our concern is that the risk of that is still elevated, and we'd like to get through that third quarter earnings season first.
Well, you owned the front half of this year, that's for sure. The second half is up for grabs. Andrew Sheets of Morgan Stanley. Andrew, awesome as always, with a team led by Mike Wilson as well on this side of the Atlantic. TK, a lot to chew over, a lot to think about.
It's a huge, John, you know, I would almost suggest that it's so uncertain right now that you're going to see a massive publication towards Labor Day. You know, the first week, I believe it's September 12th, is when we really start up again as well. Everybody's got to reset. The Bulls have to reset. The Bears have to reset. And you know, the uncertainty is so great. I don't envy these people. It's a tough job right now.
We got to reset. Jobless claims, Tom, in about 20 minutes.
Well, yeah, jobless claims in 20 minutes. And to look here at before the pandemic, 200,000, and we are in shock over those numbers. And then we've seen massive gyrations with the pandemic. But it's been a very gradual yet persistent climb up to the 260 level.
Since the middle of March, Tom, we got down to 166, back to about 262. Katie, I think we're looking for another tick higher maybe in about 20 minutes.
Yeah, 264 is the estimate today. So yes, they are still very low by historical standards. We are still south of that 300,000 figure. Where can it get up to before it starts to make the Federal Reserve think, well, this isn't intended?
Well, those worries, Kaylee, got blown up by the jobs report, didn't they?
Well, that's true.
Anyone who was worried based on claims looked at payrolls, Tom.
Worried.
You weren't worried.
John, look, the timing here of claims, the vector of claims is directly correlated with the fall foliage map of America. It's directly, John, I've been doing work on this. Tuscaloosa, the Friday before Bama, Auburn, makes sense. Thanksgiving, we'll have Thanksgiving in Kaylee on the way
you're on
home.
board. Now you're on board.
And the answer, John, is we go to Bama, then we go up to Little River Canyon, northeast of Birmingham, and we see the fall foliage of Alabama.
Very cool. Now I'm on board. We can watch real football.
We can watch real football after we watch UVA and UNC.
No, UVA doesn't play good football, Tom.
Go Who's?
They don't go for the football game. They go.
But go Who's?
For what? They go for what?
It's a family network, John.
Okay, all right. You can tell me later. Kelly, I've got no idea what he's talking about.
I don't
That's
either.
all. Good. Okay.
Never do.
That's two of us. Futures up a third of 1%.
I like that map.
This is Bloomberg.
On radio, you missed it.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. The US and Taiwan are following through on a long-time promise to deepen their ties despite opposition from China. The two countries will start formal talks on a trade and economic initiative this fall. Still, a trade agreement may be more symbolic than substantive. Both Republicans and Democrats have been reluctant to embrace free trade agreements. In the UK, the so-called summer of discontent is about to get worse. Britain's faced some of the most widespread disruption yet due to strikes by rail workers and bus and subway staff. That will be followed Sunday by an 8-day strike by dock workers at Felixstowe, the biggest container port in the UK. And more legal problems for former President Trump. The longtime CFO of the Trump Organization, Alan Weisselberg, is expected to plead guilty today to tax fraud. Bloomberg's learned that he will not implicate the former president, but he will be required to testify against the Trump company. And experts say his admission of criminal conduct could mean trouble for the business. And shares of Kohl's are falling today. The troubled department store chain slashed its outlook for the full year. Kohl's says its customers have been hurt by inflation and it's taking steps to cut inventory and lower expenses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
as a result of high gas prices, European GDP is going to decline by 1.4% next year. We do think the burden of high gas and oil prices will actually mean that we are going to see some steep contraction in the European economies next year.
There are very few people who want to take the other side of that one. That was Amrita Sen there, the Director of Research at Energy Aspects from New York City this morning. Good morning with Tom Keene and Katie Lyons. I'm Jonathan Ferro. Lisa back with us on Monday as we count you down to Jackson Hole and the Fed's annual get-together. Futures right now up 0.2% on the S&P, on the Nasdaq 100 up 1/3%. Yields down by an extra basis point. We're down 4 now to 285.85 on a US 10-year. Tom Keene, euro-dollar doing absolutely nothing. 101.76.
My recollection, John, is Francisco Blanch has led the charge on over $100 a barrel on Brent. When he said it, it was a shock. He's head of global commodities and derivatives research at Bank of America and joins us today. Francisco, I want to touch on one paragraph in your new report, which was shocking, and I know Kaylee wants to pick up on the news of the day. You tore apart our key distillate, which is a 47,000 gallons on a Boeing 777 that all of us need, that we all take for granted when we fly around domestically and internationally. You say, watch jet fuel. Why?
Well, look, Tom, I mean, I think we still have China in lockdown. We have large parts of Asia also in partial lockdown when it comes to international travel. And I think that's going to open up in the next 6-12 months. We are down 25% on jet fuel demand globally from pre-COVID levels. We could see a pickup of 500,000 barrels a day, maybe more, just on that front alone. And again, this has been the leading fuel in the last 12 months. I expect it to be the leading fuel in the next 12 months.
How will that come over to Brent crude's price? Can you extrapolate over from the new Pacific Rim demand over to over $100 a barrel Brent?
I'm definitely constructive on Brent right here. We've pulled back after the seasonal driving peak in America. But I think coming into the winter, you're going to have jet fuel demand. You're going to have demand from Europe because of the record high natural gas prices you have there. And also remember, we still have a very tight global refining system for a variety of reasons. So all of that, I think, is going to drag us back higher.
I've got 14 themes. I have to go to the social reality that Europe faces. This is not about math. It's not about spreads, crack spreads, and the rest of it. It's about multiple standard deviation moves that become social policy. Tell us how your world can help Europe in this crushing social policy of where prices are. Electricity in France is an example.
Well, Europe faces obviously a very complicated situation. If you look at European natural gas, right, I mean, 40% comes from Russia, or used to come from Russia, and you've lost right around 10% of the entire energy supply of Europe with Russia curtailing that gas. Other things being equal, that would mean a 10% GDP contraction. And what's happening right now, essentially, is Europe is trying to price itself back into the global economy, so to speak, by attracting liquid gas from Japan, from China, bringing it to the European continent. But also importantly, we're seeing the shutdown of zinc smelters, aluminum smelters, steel plants, and fertilizer capacity. So that's all imported again. So essentially, all European energy prices are rising above global prices, but importantly, a lot of the domestic produced energy-intensive commodities like steel and what have you are also being displaced out. And that's the way Europe is going to avoid a very, very steep recession and probably end up with just a mild one.
Interesting.
That's essentially the process we're going through.
Kaylee?
Well, Francisco, what I find so ironic about France is nuclear was supposed to help them out, and yet because of the climate issues and the river temperatures, it also is inhibiting their ability to use that power, which brings me to clean energy. There is now moves in the U.S. after the signing of the Inflation Reduction Act in that effort. There's also metrics within that, like a methane tax, for example, for U.S. producers. How is that ultimately going to affect supply of fossil fuels?
Well, one of the hardest parts, right, that we often forget is that the 2020 COVID collapse in demand also brought about a collapse in investment. So 2020 was not just a demand shock, was also a supply shock. We had negative oil prices. We had natural gas in Europe, TTF, at $1 per MMBTU, which is the same gas that's trading at $80 an MMBTU, right? almost like a cryptocurrency, if you like, and not precisely Bitcoin, one of the more extreme ones. And this is a real commodity that actually people use every day. So, I think fossil fuels have a tough future ahead of them because nobody wants to sign long-term coal leases, right? And no financial institution or no major financial institution wants to be financing thermal coal either. It's hard to get financing for conventional oil and gas. Or just shale gas. So I think the issue is going to be in the medium term. We are trying to move very fast into a greener economy because we have these pressures coming from climate, and we've seen them. Right, part of the problem you talked about French nukes. Part of the issue with the French nukes is that we don't have enough water on European rivers, which is a function of glaciers melting fast. Right, so we're starting to get all the compounded effects of climate change across the energy supply system. And I think it's obviously very important to move quick to green fuels, but at the same time we have this gap, and unfortunately, remember, prices are just the balancing item for supply and demand in commodity markets, and we continue to expect very high volatility, continued inflation, and of course a lot of basis risks in terms of differentials, time spreads, and cross commodities across the complex. So I just don't think, I think commodity markets are going to give us a solution, but it's all going to be extreme pricing for a while, and we remain constructive on the complex.
Francesco, I've got 30 seconds left. Can you tell me what you think Europe looks like this winter? Are we going to do a 4-day work week? What's going to happen with the effort to curb consumption?
Europe is going to have to curb consumption by definition. It's, as I mentioned at the very beginning, it's happening already with curtailments of energy supply to industry, but also curtailments of temperatures at home during the summer and during the winter as well, right? So we're going to see forced reductions, potentially rolling brownouts in some parts of Europe, right? I mean, this is what it looks like, and it's almost it's almost like the developed markets are becoming emerging markets, and in a weird kind of way. So
Francisco Bluch there of Bank of America Global Research. Francisco, awesome as always. Tom, we got to prepare for something that we've only just started really talking about. Well, I think what does it look like later this year?
Yeah, we have the huge advantage here of our hydrocarbon team and our green team on this. But to your point, John, this is not about economics, finance, investment, and the rest. These are social policy issues in Europe.
Big public policy decisions that will need to be made later this year. Futures positive 0.2%. Jobless claims coming right up. That's next. This is Bloomberg. Jobless claims in America coming up very shortly. Mike McKee's going to break that down for you. Going into it, futures positive 0.2% on the S&P. On the Nasdaq 100, up 0.25%. Treasury yields down 6 basis points now. There's a move, 283.85 on a 10-year. Even with that move in yields, we are unchanged on euro dollar 101.82. With the jobless claims figures, here's Mike McKee.
Well, all of you who were worried about the labor market loosening up, jobless claims fall significantly down to 250,000 for the week last week, and that is significantly lower than the initial 262,000. We're still waiting for the revisions to come in. Continuing claims, 1,437,000. That is a little bit of a gain, about 9,000 more than last month, but it still suggests that we are not seeing people who lose their jobs stay unemployed for long. You're able to get off the unemployment rolls fairly quickly. Philadelphia Fed comes in at 6.2. Last month it was positive. Negative 12.3. And remember, we had earlier the Empire Index and a major collapse there, down about 42 points. In this case, the Philadelphia Fed changes the other direction and goes positive. Philadelphia Fed New Orders Index is at -5 compared to -24.8. So that's an improvement, even if it's still showing a little bit of contraction. And the other thing about the Philly Fed is prices paid. Prices paid is jumping around on my screen here, but prices paid is 43 56.6 versus 52.2. So prices paid come down significantly in the Philly Fed. So the labor market stays strong, and another signal that maybe inflation is backing off just a little bit. We'll have to see how this all translates to the ISM the week after the Jackson Hole.
It's all relative, but the data pretty decent relative to what we were expecting this morning. Futures still positive, up 0.1%. I said that Treasury yields were lower by almost 5 basis points going into the number, now down just about 3 basis points lower to 2.86 on a 10-year, down about 3 basis points at the front end to 3.25. TK, the data's okay going into Jackson Hole next week.
Data's okay going to Jackson Hole, and of course that will drive forward to the speech of Jerome Powell. I like what our next guest says, Stephen Stanley, with his chief economist, Amherst Pierpont Securities, where he goes back to Cool Hand Luke, and it may not be Paul Newman. He looks like Paul Newman. It may be Cool Hand Jerome that will speak there on a failure to communicate. Stephen Stanley, let's go to the Fed right now before Jackson Hole. How must they communicate as we stagger to Wyoming?
Well, first of all, I have to tell you, Tom, you're the first person that's ever compared me to Paul Newman, so I'll take that as a great compliment. So yeah, it seems like every time the Fed tries to communicate, and they pound the table, stomp their foot, however, whatever expression you want to use, that they're going to continue to tighten until inflation is brought under control. The markets find a way to take out of it something dovish. So that this happened at the FOMC meeting a few weeks ago. It happened yesterday with the minutes. The markets are focused on the idea that the economy is softer and that the Fed is not quite done yet, but that maybe by the end of the year it will be pretty close to done, and that it'll be easing by the second half of next year. And the Fed continues to push back hard against that, and the markets are just not having it at this point.
Stephen, did Greenspan communicate? I mean, long ago and far away, we used to decide if he was eating a ham or, a liver sandwich on the way to the Wednesday meeting. I mean, do you suggest that there's an over-communication now versus what we knew with Alan Greenspan?
There is a lot of communication. I think the Fed, they maybe are feeling a little bit regretful about the fact that they went to this thing of being very specific about what might happen at the next meeting. They did that a couple of times, and it didn't really quite work out the way they had planned, I suppose, and they stepped back from that in July. But it feels like it's a one-way ratchet. I mean, once you become more transparent and communicate more, it's very hard to take that back. And so I think the Fed is, continuing to try to be explicit about what they're doing. At the end of the day, it's just a different view about the economy, I think. I mean, the Fed officials, for the most part, are continuing to push the soft landing story. The economy's fine, the labor market's strong, everything's going to be okay here. We're going to slow down, but we're not going to see a recession. And the markets are, thinking we're either in one or we're about to be in one. And not only is the economy weaker, but that weak economy is going to very quickly bring inflation down, which is another variable in the equation that I think the market might be a little bit too optimistic about.
Stephen, what they're picking up, I think most market participants that are reading this and thinking it's dovish, they're picking up a lack of conviction, a loss of conviction, and now two-way talk, where before it was just one way. And I'll tell you the couple of lines, and you've read them, and I know that the Fed minutes are very long and you can make them tell you whatever you want them to say, but these are the lines that jump out for me. It is likely that it would be appropriate at some point to slow the pace of policy rate increases while assessing the effects of cumulative policy adjustments on economic activity and inflation. That on its own is obvious, but pair it together with this. Many participants remark that in view of the constantly changing nature of the economic environment and the existence of long and variable lags in monetary policy's effect on the economy, there was also a risk that the committee could tighten the stance of policy by more than necessary to restore price stability. You put those two things together, Stephen, it totally undermines their effort to say the following. They reaffirmed their strong commitment to returning inflation to the committee's 2% objective. Stephen, that just does not sound as strong as it did a couple of months ago. Do they have to stop saying what they said in the minutes in order for people to believe essentially what you believe?
Well, as you said, I mean, the minutes are long, right? They're 12 pages long, so there's always going to be something you can pick out. And I thought it was interesting because that second quote that you read about many participants felt that there was a risk that they would overdo it, came at the end of a paragraph about risks. And the primary risk was that they were going to have to go by more, that inflation would stay higher for longer and force them to go by more than what they, their base case. And so You're right. There are always risks on either side. And as I said, I think the market has a different view of the world right now than the Fed does. And as a result, they're willing to put more weight on the risks on the more dovish side. At the end of the day, I guess what matters most is what the Fed does as opposed to the messaging. And of course, the last two moves have been 75. They can't continue to go 75 forever. So this idea that they're going to slow down at some point, of course, as you said, it's obvious. But even if they go 50 in September instead of 75, the bigger question is how much longer are they going to have to keep going? And I just feel like inflation is going to stay high for much longer than what seems to be embedded in the markets right now.
Well, to that point about some of the stickier parts of inflation, I look at that Philly Fed number, which actually surprised to the upside. In theory, maybe that is having to do with some of the supply constraints easing at the producer level. That's goods inflation, though. And in services, that's where we're starting to see things really picking up on the wage front, on the rents front. If those are persistent, where does that leave the Fed, even if headline CPI is coming down because of gas prices?
Exactly, and that message was delivered in the minutes. There was, the sentence that I just mentioned that they said there was a risk that inflation would stay high for longer. There was another sentence in a different place that said they felt like it was going to take a long time for inflation to get back down to their 2% target. So I think in some ways, I talked about the debate over the economy and where the economy is, but the most important debate around monetary policy, in my view right now, is how long is it going to take for inflation to get back to normal or back to the Fed's target. And I just think we've had high inflation for long enough that while the longer term expectations numbers don't suggest that we've seen a sea change in how people look at inflation, you can just see in the straws in the wind that it's starting to become a fact of life for people. And I don't think it's coming down quickly. You mentioned rents, you mentioned wages. I think those are the sorts of things that are going to give inflation some staying power. I do have confidence the Fed will eventually do what's necessary and that we'll ultimately get back to something close to 2%, but it might take 2 or 3 years rather than 6 months.
Okay, so we had this conversation earlier. How long do you think they have to stay at the terminal rate when the market's expecting cuts within the next year? That not realistic?
Right. No, I think that's very unrealistic. And you heard that last week out of a number of Fed officials. I would be interested to see what the speakers today have to say as well. But I look at the dots and my own Fed outlook is a little more hawkish than what the June dots showed. But the June dots kind of suggest that the Fed expects to be at the peak rate for about a year before they start to ease. That's kind of how I read it. So I think that seems pretty reasonable to me, but they're not going to start easing until inflation is at least in the neighborhood of back to the 2% target.
Stephen, what's your peak rate?
My peak rate is 4 5/8. I have us getting there by around the middle of next year.
That's one heck of a number compared to what people are talking about on the street at the moment. Stephen, awesome to hear from you. Of Amherst Pierpont Securities, a Santander Group company. Stephen Stanley there, the chief economist. TK, that's a big number.
We're not used to it yet. And I'm sorry, Bloomberg Economics is even higher than that. And John, the path to that is really what we're talking about. All of what we were talking to JP Morgan about earlier is this to me, it's the timeline there, and it's got to be a timeline that gets out into 2023. This is not going to get fixed by Christmas.
The time spent at that peak rate, Katie, ultimately to get inflation back down somewhere close to 2.
And that's the thing, John, is that as we're having these conversations with economists, with strategists, all who are saying the market has this wrong, ultimately the market pricing is unrealistic, this market is fighting the Federal Reserve. So how hard does Chairman Powell fight back next week in Jackson Hole? Because clearly he has his work cut out for him.
Still waiting for confirmation of that speech over in Jackson Hole from Chairman Powell. Tom, we're assuming it's going to happen. I assume it's going to happen.
Well, maybe
we'll
I
see
don't
who
know
else
if
is there.
Zoom or is he there?
I think in person, Tom. It's got to be in person. Come on.
What was the place you took me at Jubilee or Piccadilly? What's the breakfast place you took me to in London?
Where are you thinking? I can't remember, Tom. We've done this so many times.
Greer's it's like a morning breakfast place in London.
Are you thinking by Fortnum's?
Yeah.
I can't remember the hotel now.
I can't remember. It was expensive.
It's not the Wolseley.
Citigroup. The Wolseley. That's what it was. Citigroup out with an American equivalent breakfast on Krispy Kreme. John Tower says a Krispy Kreme donut. It's highly discretionary. John,
okay.
I think
it's a very different breakfast, Tom.
Listeners or viewers
never had one
with that.
You've never had a donut,
You've never had a Krispy Kreme donut?
No, she's never had a donut, Tom. Never mind Krispy Kreme, never had a donut.
Oh, God, a sheltered childhood.
I'm not sure what's going on with that, Katie. We can talk about that another time. In the next hour,
It's
we will
worse
not be
than the
talking about
foliage.
confectionery and the fall. We'll talk about markets with Matt Brill of Invesco, Elliot Hoxter of Pigtech.
Jack Manley wants to talk about foliage.
JP Morgan Investment Management. I think he's going to give that a miss. We'll do that going into the opening bell. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A new study highlights the mounting burden of chronic illness left in the wake of COVID. Researchers at the University of Oxford found that survivors remain at higher risk of psychotic disorders, dementia, and similar conditions for at least 2 years. The findings are based on the records of more than 1.2 million patients. Shippers may get some relief from a crisis that has snarled the transport of energy products and other goods along one of Europe's most important rivers. Water levels on the Rhine are set to rise over the weekend at a narrow waypoint west of Frankfurt. The level is at a point where many barges find it uneconomical to transit that stretch of the river. China is lashing out at a $52 billion program to expand American manufacturing of semiconductors. An industry association says it contains elements that violate fair market principles and targets China's own efforts to build a chip-making industry. The legislation prohibits companies that receive funding from expanding production of advanced chips in China. And the American owners of the iconic English football club Manchester United may sell a minority stake in the team. Bloomberg's learned that buyout firm Apollo Global Management has expressed interest. British businessman Jim Ratcliffe is another name in the early mix. Manchester United fans have called for a change in ownership because of the team's disappointing performance in recent years. Global news 24 hours a day on air and on Bloomberg. A quick take. I'm Ritika Gupta. This is Bloomberg.
What's vulnerable here are the stocks that have rallied the most. So when you think about the long-duration tech stocks and the growth names, they've bounced back the most. They've bounced back because 10-years have moved lower. So I think there's going to be some sort of reversion to the mean there.
Alicia Levine, stepping carefully through the optimism of the moment. We've heard that from many other people. She is with BNY Mellon Wealth Management. It is important to speak to Daniel Ives at important times for the big tech that he follows. He's been steadfast in his optimism, and of course, he's got a massive victory lap going over the last 8 or 9 weeks. Apple Computer, to put things in perspective, 2 to 3% below a record high. That is a tour de force for Cupertino and for Mr. Ives, and he joins us now. I'm going to go right to it. You know what I care about, Dan Ives, which is the chips that are in all these miracle toys we use. The new Apple phone in September will have the A16 chip, which is 5-nanometer technology, blah, blah, blah. Is that enough to get Kaylee Lines to buy a new phone?
I think it's Kaylee and about 40 to 50 million others, because I think what you're really going to see here, this is a catalyst that speaks to the pent-up demand that we see across the install base. 240 million of 1 billion iPhones worldwide have not upgraded in 3.5 years, and I think this is still significantly underestimated by the street.
Dan, I take huge issue, as I know you do, with the way the media tosses out, OMG, why would anybody buy a $900 toy? What percentage of us are buying this on a monthly plan? And is that worked out for Apple and, frankly, for the cell phone providers?
Well, it has. That's about 40% from a monthly perspective. And you put that together, it's ultimately, especially with what we believe is going to be a $100 increase on the iPhone Pro Max, it's become more digestible. And remember, you haven't had a price increase in, call it, 4 or 5 years. And I think you're starting to see consumers now more and more look at a $1,000 iPhone as really paying the price of what they expect to be when it comes to Apple.
What about in China? I understand that the U.S. consumer is in a pretty healthy position, but we've actually seen Apple doing discounting in China on higher-end models. That's a pretty important market for them. What is your read on how that's going?
Yeah, it's a great question. I think in China, we estimate about 30% of the Chinese consumers in terms of iPhones are in a window of an upgrade opportunity, and actually more and more pushing toward the higher ASP Pro Max. That's very important as this all plays out, because that's the hearts and lungs of the Apple bull story. And I can tell you this week, our checks in Asia are basically showing firm demand in terms of coming out of the gates for iPhone 14, which looks like the launch date, called first week after Labor Day.
Mm-hmm. Yeah, September 7th is coming up quick, Dan. Of course, for me, I have a ton of Apple products. It's more about the ecosystem because my phone connects to my watch. I get iMessages on my Mac laptop. I have the AirPods that hook up seamlessly to my phone. I mean, it's the whole thing. When people upgrade an iPhone, what about the rest of it?
Well, services, that's really been the key to the valuation re-rating that we've seen. I mean, that's going to be $90 billion of annual revenue going into next year. And that's why they have a golden install base that's unmatched.
Dan, I want to get through this quickly just because of time. The 1% tax on share buybacks, is that going to ruin your world, the Dan Ives world?
I view it as noise. It's not going to change big tech buybacks.
Okay, I want you to frame for all the gloomsters out there in Apple now, your buy on Apple. 3 years out, where is this $170 stock?
Look, haters will continue to hate in Apple. I view this as it exceeds $3 trillion market cap. 220s are base case. 240s are bull case. And this just continues to be what I view in the middle innings of just an unprecedented upgrade cycle despite the dark storm clouds.
Dan Ives, thank you so much. Thank you for your work at Wedbush. It must have been extraordinary on this hugely popular part of the market. Kaylee, I was on the back end. I had the Vegas memories of the Nifty 50, which was the vogue of Mad Men era. I didn't participate in it, but as a kid, I'd hear parents talking about it, Johnson & Johnson and Anaconda Copper and all the rest of it as well. The Nifty 50 now is this love affair with Apple and the rest of them. You just say to yourself, when does this end? That's what the bear case is.
Especially when it seems that they've just taken over the entire market. I mean, when we talk about these companies and their businesses, we're also talking about the vast majority of the S&P 500. I mean, the weighting of Apple, which is the world's largest economy, in the S&P alone, it's what, 7% of it, 7.5%? It's remarkable. And of course, we've seen a real comeback in these stocks. These growth stocks have been the ones that have led the rally off the bottom in June. The question is, can they continue to lead the way, and how much of that is dependent on bond yields?
Okay, we had a listener on radio listening in the Shenandoah Valley, which, full disclosure, folks, is spectacular in the fall. And he took immense issue with the subservient attitude people have over UVA football. Now explain to our international audience, basketball's dominant, right?
We used to be. We're getting back there. Tony Bennett is a great coach. We're a defense team. Everybody knows that. But yes, we are traditionally better at basketball than we are at football. But really the only football game that actually matters, if you're a UVA fan, is against Virginia Tech Thanksgiving weekend.
Against Virginia Tech.
Yeah.
How far distance are they from Charlottesville?
Not far, a couple hours to Blacksburg from Charlottesville. But
I was talking culturally, how far distance are they?
Virginia is an interesting state, Tom, as I'm sure you're well aware. Central Virginia, Northern Virginia, a little more politically aligned. You get outside of those population centers, it's a different story.
Nice. I was trying to get her in trouble there. That's very difficult. Sounds like she's running for office. Virginia is a very interesting state. Kaylee, I want to go to crypto. What are we going to do at 23,000 crypto? You're getting ready for a Tuesday show right now. I mean, it's extraordinary.
It is. And it's interesting as you've seen kind of speculative behavior showing back up in the meme stocks. You aren't necessarily seeing it translate through the entire crypto universe. There's still a lot of fear out there about the crypto winter. And it doesn't seem that retail investors are as anxious to get back into crypto as they are into some of those the moon stocks.
Let me cut to the chase. Should these gazillionaires that have lost all this money, should they be apologizing to their acolytes?
It's been an interesting silence from a lot of them, Tom.
Exactly.
And a lot of the celebrities, too, that have endorsed some of these companies.
Now, crypto is a very interesting state, as well as Virginia as well. Kaylee Lyons, thank you for sitting in for Lisa through this extended holiday that she is on. We're getting ready for Jackson Hole. Stay with us for good conversation. This is Bloomberg. Good morning.
Special Western and Southern Open update for Bloomberg TV and radio from Tennis Channel. I'm Jamie Maggio. The stars of the ATP and WTA tours hit the spotlight Wednesday in Cincinnati. Rafael Nadal is out. The 22-time major champion went down to Croatia's Borna Coric in a rain-interrupted match. The Spaniard was making his return to the tour after an abdominal injury forced him out of Wimbledon. Rafa was looking for his 5th title of the season in Cincy and will have to find some hard court form ahead of the final major of the year in New York. And on the women's side, Iga Swiatek looked back to her best as she took out former U.S. Open champion Sloane Stephens in straight sets. The world #1 reaching round 3 in Cincy for the first time in her career. And don't forget Tennis Channel's daily live coverage from the Queen City all starts at 11 a.m. Eastern.